categories have options you can choose from. Price and volume, for example, has 36 items. So let's just see which one is up. If I were to say price today, price percentage change current day, let's see 5% is my minimum. So of the 244 stocks, there's one one that's up 5%. See, and it gives you feedback too. I can see, well, that's pretty tight, my screen. It's probably too tight. Let's go ahead and change that from 5 to 1. And now there are 30 stocks that are up at least 1% today, and you can see them populate down below in the list panel.
Right. And you can see DGII there. You can see AZO, a bunch of names that came from my list, my focus list today. So those are stocks that are going to be in that stage 2 uptrend, in an uptrend. And now you can overlay criteria on there. But now you're starting from that database of being an uptrend. So now you won't be tempted to maybe buy those stocks. Times people show me a stock and they'll say, what do you think of this? I don't even see those stocks because I'm not screening, those will never make it through my filter. So I don't even see those names. I'm not even tempted to buy the falling knives and the stocks that are in downtrends and so forth.
Exactly. You're starting from a much cleaner universe of potential ideas, right? And so,
right.
But you could, this would be like a daily screen, so to speak, something you could do during the day when the market's open. If you wanted something more of a research related, you could say, I want the stocks to be within, 20% of new high, or I want the stock to have been up at least 12% in the last 3 months, and so on and so forth. There's a million ways to slice this, which is like what you mentioned.
Yeah.
I'm going to turn off that figure. So in the last 3 months, there are 101 stocks that are up at least 12% or more in that list, things like that.
Yeah.
Like Mark said,
if you want to show whatever you want to show features,
sure.
feel free.
Yeah, what you said about the screening is very important. So unfortunately, it would be cool if we had a screener that said, these are the 10 items that I love to look at. Give me the stocks that meet 7 of the 10 criteria. We don't have the logic for that. So the screener is very all or none. So you want to segment your screen. So if I'm looking for IPOs, I just create a screen based on IPOs, like Mark said. Or if I'm looking for stocks with big sales, I think I heard Mark Cuban on a TED Talk or a podcast or something where he talked about sales being a big thing. So I was like, oh, okay, let me just build a screen based on what he says and just see what shows up. So, I experiment a lot with this just to try to get an idea on what the market is, pushing out as far as potential ideas.
Yeah.
If you want to, now that's the custom screen. If you want us to do the work for you, then what Mark mentioned, the open stock ideas, this is your best bet. This is the table of contents for all the best screens and reports that we find most of our clients are using. So you've got breaking out today, stocks that are near a pivot based on the algorithm that we have, the pattern rec algorithm, stocks that have broken out in the last 3 weeks or less based on that same algorithm. RS line blue dot. So relative strength's a big deal, I imagine, to most of you. Stocks where the RS line is at or new high, and the stock is, I have my pattern rec off, so bear with me, I'll turn it on. So this blue dot is telling me that the relative strength is at 52-week highs, and the stock is either in a base or recently breaking out of a base, as in recently meaning this week. So here's Ashland, very close to the top of the space, and the relative strength line is at all-time highs, 52-week highs.
And I love the blue dot to run that in a bear market. That's a screen that you should always run in a bear market. RS line near new high, and this narrows it down a bit more. looking at the stock price in a base and near a new high. So this is one that where the leaders, it's almost impossible for the really the best names and the leading stocks to get by you if you run this in a bear market, because they're the ones that, while the market's in a downtrend, they're holding up. They're building bases. The RS line is moving up, because even if the stock doesn't go up, if it goes down less than the market, that's going to improve the relative strength. So this is a key screen to run. Scott, also something that I love that you guys have added is you can put RS line near a new high with a certain percentage now.
So that would
It
be
gives you a little heads up.
a screener item. Yep. So if you want to get ahead of the curve, like you said, yeah, you could say, if I go to, let's open this and go to price and volume. And so you've got relative strength line is within 5% of a new high. So you just choose yes in this case. So you've got RS line new high, yes or no, if you or new low. If you're interested in shorting, you could do that. But you just choose yes in this case. And let's turn off the other parameter. But within the 5-month wide, there are 78 stocks where the RS line is within 5% of the new high. Of its new high, the RS line's new high, not the stock price.
Yeah, I call that my orange dot screen. Get the blue dot, that's orange dot.
I like it. Yeah, though the blue dot has 2 parameters, right? You've got the RS line, but you also have to have a base as identified by the algorithm. That's both good and bad, right? And maybe you don't like the base. Maybe there's an earlier entry that you might use.
Sure.
And the algorithm doesn't see that earlier entry, so that's why I think you want to do both. You got the blue dot, and you have either a screen like this, or down below, we have a list called all RS line new high. So every Friday, it's just going to screen the database for all the stocks where the RS line is at new high ground, and just give you a list, regardless of the pattern, regardless of the fundamentals, the technicals. All it's looking for is a relative strength line at new high, yes or no, and it creates this list for you. You can see there are 351 items. It is it's sorted by event date, so the most relevant names to you would be on top. As you scroll down this list and do your work, it's going to become more of a history book, so to speak, of previous RS line new highs, which is fine, but just keep that in mind. And the names will stay in this list for 45 days. So after 45 days, they'll fall off. Unless the RS line is still a new high, then it can stay in there.
And I should point out that when you take something like a screen like this and you build the trend template, my trend template in there, and you're using RS lines in new high or near new highs, if you went back and you ran this and you looked at when Amazon came out of its bases, and when Netflix, and when Google, and when all these big leaders, that some of the best stocks ever, they all would have came up on this screen. You're not going to miss the leaders. You're definitely going to see the stocks in the uptrends, because all of those stocks bottom, the best stocks bottom before the market. So you'll see the market will be in a bear market, and the best names are already in uptrends. So this will pick that up, and that's why it's important to run this, particularly when you're in a correction or a big bear market.
And Mark, a common question we get, I get emails all the time because you have so many people across the globe. We are U.S. listed equities only. We do have ADRs, but it has to be, BABA, Pinduoduo is in Marcus Smith, but it's all U.S. listed stocks only. We don't have any foreign exchanges, unfortunately. And a question somebody asked about the RS rating. Our RS rating is a little different than most people. It's not like an RSI, like an overbought, oversold. It's more, it's measuring relative to our entire database. So the best way to think about the 89 for Ashland in the last 12 months, and it's not a perfect trailing 12 months. There is some proprietary nature to it. It does weight the current environment more. The 3-month and the 6-month performance is weighted. But as a general rule, in the last 12 months, Ashland has outperformed 89% of the stocks in our database. That's what an 89 would be.
So just to let you guys know too, I stopped out of the ALNY just like we said, we're looking at the intraday as sort of as the daily, and the daily as the weekly, sort of an exercise. We did take out that low, and we're breaking down here. We didn't get that support. We had 1, 2, 3, 4, 5, 6 lower lows, a dead cat bounce. I know the charts I'm not sharing right now, but I could show you later.
Yeah.
And
Do
then
you want to switch?
no,
Do you want
that's
to take?
fine.
Okay.
It's okay. No, keep going. I just wanted to point that out and just let you know that I did stop out of that. So I got knocked out of that trade.
Okay. And
Still in the
somebody asked,
ABM.
I'm sorry, Mark.
Yeah, go ahead.
Somebody asked about comparing the stock to the S&P. Well, we do that for you automatically with this relative strength line. So I'll pull up Apple, and bear with me. I have 2 relative strength lines on there. So let me take one off to make it cleaner.
And it's important to point out that another change that you guys made is that you can have you can compare it to the NASDAQ or the Russell too.
Correct. You could compare every stock you want to Tesla if you wanted. I mean, you can
Right.
choose anything. But this line is the Apple's performance versus the S&P. So in essence, Apple is outperforming the S&P, or let me choose something that's a little bit easier to see. So here's Tesla going up, outperforming the S&P, going down, underperforming the S&P. And even if the S&P was going down, if Tesla's going down more than the S&P, that line will be, turning and pointing down. So that's what that relative strength line is.
Yeah, and you can see Tesla is turning into a textbook example of stage 2, stage 3, stage 4. You're turning down to stage 4. It got very toppy there. Took a long time for that top to form, but now you've rolled over. You've taken out those lows. The 200-day is in a downtrend. You're getting into that stage 4 decline now.
John asked about, he noticed on your screen and mine that I have like gross margin here for Tesla. And he has dividend PE. So this is something you can customize. So John, you would want to click on the wrench in the upper right corner, and in the drop-down menu, do you see the quarterly data blocks? This is the standard dividend PE range, but you can change it after tax, pre-tax, gross margin, return on equity. So if I just click on pre-tax margin, for example, now you'll see the pre-tax margin below the quarterly earnings and sales data block. Yep, of course. Thank you. Somebody asked about the price, the scale, the logarithmic versus arithmetic. We just have a standard for the daily. You can adjust a weekly chart if needed. So right now on my weekly chart for Tesla, I am on price scale standard because it tells me best fit. Yeah. If I wanted to see this price action that's kind of off the chart, then I can tell Marcus Smith, fit the prices to the chart. And now it's going to scrunch it all there so it fits. And it lost its mind with the pattern rec when it did that, but you get the idea. So we only have those standards. You can't adjust them how you prefer to do it. For what it's worth, I prefer the standard view. I think the standard is the best way to look at them, but you can play with it and see how it looks for you. Somebody asked about adding moving averages. So that, again, we're going to be in the wrench, click on the wrench and choose moving averages. Marcus Smith has, let's talk daily chart, a 50 and a 200-day are automatic on the chart. You cannot adjust those. You cannot remove them. They're just there. So there's the 200, which is black. There's the 50, which is red. But you can add 2 custom time moving averages, I should say, to the 3 different time periods. So here's the daily option. Here's the weekly option. Here's the monthly option. So if I wanted I've got the 21-day, but let's scroll. If you see, you got the scroll wheel. If you wanted the 28-day moving average, whatever, you did a study, that's the magic number, great. You want it to be exponential, no problem. You just hit apply changes. And now the green line is that 28-day exponential moving average that I just added.
Scott, one of the things that it's a very simple way to use MarketSmith, but I find it to be one of the most powerful, is that when you run a screen, if we can go back to screening, and if you cast the net wide, like I said, let's just say you look at all the stocks that are in the trend template that are in uptrend, which right now in this market, there's not very many. It's a couple hundred. When the market's in a strong uptrend, a bull market, I've seen that up 900, 1,000 names. But what I like to do is set up my headings. So you've got the composite rating, RS, and then from there, just sort. The sorting function to me is one of the most powerful tools. I just want to look at everything in an uptrend, and then I can sort in relative strength. And then I look at them from RS, from top RS down. If I'm looking for stocks that I want good fundamentals, I just sort in SMR rating. If I want to I can sort in composite rating, and that takes in account the group and everything. And you're going to probably see solar names in there, and the oil names, the stocks that are acting the best. So the sorting function, even right down to the IPOs, where I just sort in IPO date. So then I get the ones that are the shortest and the most recent. And then as I'm screening, it elongates. I hit the space bar and I scroll my way down. So I just find that the sorting function, if you cast your net wide and then use the sorting, it's very powerful just in that alone, just a very simple way to apply it.
I agree. If you get a big list, let's say you do a screen and there's 600 names in there, it might seem daunting to you. And so by sorting it, in this case, I sorted by the comp rating, brought all the 99s to the top. And if I just double click the very first stock, which is AIT, I'm going to close the screener here by just hitting this tab. And then I will hide this list panel. That way I get better real estate on my chart. So I'm going to hide it with this mini icon. And now I'm starting with all the 99s. And every time I hit my space bar, I move to the next 99 and eventually 98, so on and so forth. At some point, you might say, this is just not fruitful. I don't like the setups. I don't like the quality of the names. And you can just, stop and move on to your next screen or report.
Yeah.
And you can do a double sort, Jay asked. Sure. Yep, for sure, Jay. So
yeah.
The sorting is like a tiebreaker. So if I were to sort by market cap, it wouldn't make sense to do a second sort because all these numbers are so random and there's not going to be any tiebreakers. But with the proprietary ratings, especially if you have a quality list, there could be a lot of ties. Like I just scroll down, I can see there might be 30 99s. And so what it does, it's auto sorting the 99s based on alphabetical order. I'm going to click on this little yellow padlock. It's very subtle. You might not see it that well, but if you click inside that padlock, it'll lock it. And now I'm going to tell Marcus that I want a secondary sort. I want what I like to call a tiebreaker. So let's choose EPS rating, for example. So are there any 99.99s? Yes. There's 2, 4, 6, 7 of them. So now it's a much better list as far as quality. 99.99 at the top, 99.98, 99.97, and so on and so forth as you work your way down.
And you can do that with 3. You can add another one if you want to add SMR. And the good thing about that is, so now you're going to see 99.99s, then you're going to see 99.98s. So the reason why this is a good thing to do is because you want to prioritize the best performing names, the names that have the criteria and are showing the leadership profile, the criteria that is consistent with a leading stock. And so that's why I like to screen from the strongest to the weakest and then scroll in that direction, prioritize on my work the stocks I'm always favoring the stocks that are acting the best.
And when you do that, when you scroll through, Doug asked about, split screen. So I can't split screen the single monitor, but if you have a dual monitor system, like probably most of us do, like you look behind Bob, you can see all those screens. You can put a daily, a weekly, a monthly, an intraday right next to each other. And so you click on this little chart right there. It's a tiny little chart. It's called a new chart window. So if I click on that, you'll see that now I've got two charts, and I'm going to make this one the weekly chart. So I've got my main Marcus Smith chart is a daily. I want the next one to be a weekly, and you could rinse and repeat. You want a monthly, you want an intraday. You want to tell Marcus Smith to talk to each other. So let's tell it receive symbols from main chart with this button. And you can't see my screen because, you can only share one in Zoom, but I'm going to move the weekly over to the right. And now as I spacebar through the list, I go to Vertex Daily, and automatically you can see it's changed that other chart to a Vertex Weekly. Huge time saver, especially if you look at 500-600 charts a day, or a weekend. And if you like to look at more than one time frame, think about all the clicks that you'll save by doing that. So I would guess most of you have a dual monitor system. If you don't have one, and I probably would suggest you get one. It's a huge time saver in that regard for the different time frames.
You can also organize this on the iPad. Is actually really nice. On the iPad, you can split it, and you can, and they actually puts all the charts stacked, so you can scroll through them, and you can even put, I think you could put three, right? You could put a monthly, weekly, and a daily, which is really nice. So the iPad has a function that's really great. I use it. I have the large iPad, and I'll sometimes, when I want to, on a Sunday when I'm watching football, I'll sit there and scroll through on the iPad.
Yeah, the iPad can do in one screen what the browser can't, unfortunately, at least at this point. Maybe in a future upgrade, we can get the browser to do that. But and it's gonna scrunch your chart a little bit. But if you just kind of want to review a bunch of stocks, it's a cool way. Okay, Chris. Yeah, sure, Chris. For the split screen thing, I apologize if I went too fast. If it's this little chart window right up here, if you hover your mouse over it, there's a bunch of icons up here, but it'll say new chart window. So you just click on it. You tell it the time frame. It's like a normal chart, pretty much. You just tell it the time frame you want. I want this one to be a monthly, or I want it to be an intraday. And you just, if you want them to talk to each other, that way you don't have to change the symbol each time, which makes total sense. Click on this button that says receive symbols from main chart. Oops, and I dragged it too quick, but then you just drag it to where you want it. And now when you're space barring through the list, Marcus Smith is changing all the open charts you have. The stochastics, I'll defer to you, Mark. I don't use the stochastics, so you can say yes or no, or yay and nay on this, but I'll tell you how to add it. So in the upper corner, you've got the wrench. In the drop-down menu is stochastics, and it's going to create the stochastics above the chart. Take it away, because I just have, I've seen it for 20 some years, and I've just decided it's just too squiggly for me.
Yeah, I've never used stochastics,
Okay, good.
or MACD or any of that stuff for individual chart analysis of a stock. So I would, if doing what I do, I would stay away from it. And I know O'Neill would never use stochastics. But again, the charting programs are designed so there's people using this. There's investors out there that are value investors and are buying stocks that are down and oversold, and Marcus Smith is valuable for them too, even though it's been built around the O'Neill and the CanSlim criteria. It's really geared towards, but it is certainly flexible enough to be used for other applications, the strategies as well.
Yeah, so we don't have like MACDs or Bollinger Bands, and the reason is, like what Marcus said, this product was geared towards the William O'Neill investing style many moons ago, and it's kind of stayed that way in a kind of a legacy version. Now, we would like to add stuff that way. I think in a perfect world, we give you everything and allow you to say yay or nay. So the stochastics is a nay for me. I just turn it off. But some people, they ask about it, they like it, and so at least you have that option. So yeah, and eventually we'll add things like that, but mostly it's clean. The chart is designed the way Bill preferred it to be, and we've kind of stayed the course through all the years that way.
Yep.
Can I create a screen? Oh, good question. So somebody asked if I create this screen based on Mark's 5-month wide list, for example, fast forward 6 months from now, the 5-month wide list is going to be different, right? It will update automatically. So this,
Oh,
if
yeah.
you every Friday, this list changes. Maybe it's very subtle from week to week, but it will change. So in 6 months, if there's 500 stocks in the 5-month wide, your universe at that time will be all those 500 stocks. You don't have to do this each time.
I think, Scott, I'm not sure. I think I think it was weekly updated at one time, and I was trying to get it to be updated in real time or, daily. I'm not sure. Is that still weekly?
It is, yeah.
No?
Every
Yeah.
every Friday after the close,
Gotcha.
give or take a few hours, the list will change.
Gotcha. That's the only drawback, is that intra week you do, and that's one of the reasons why, even with my own screening, when I showed you some of the screens that I use, when I just look at the high RS names that are off the highs by a certain percentage, and even if I don't put in that criteria and use my own trend template, I'm seeing everything. I'm going to see everything that's in an uptrend, and there might be a few stocks that don't meet some of the criteria, but 99% of everything I'm going to see. But I'm able to do that daily because I do screen on a daily basis.
And so, if from a resource standpoint of programming hours, it would be cool. That would be one of the many things that I would like to add, is just to be able to make that more real time and things like that. So
Yeah.
it's something that we probably will have, but yeah, as we sit here now, it's only changing once a week.
And maybe on your weekend work, when you do my big screenings on my weekends, and that's where I do I run a bunch of screenings. I sort of do my big screening, and then I do lighter screening throughout the week, sort of on the backs of those results. So maybe you could use that on your weekend work, and then as you go throughout the week, you have some utility screens.
Agreed. I think that's the best way to attack this, is a very thorough, strong weekend routine. And then depending on, you know, some of us have day jobs, and it might be hard to do screening and research on a Tuesday afternoon or a Tuesday morning.
Yeah.
But if you have that strong foundation, you've prepared yourself with that weekend work, then you're ready. And then if you can, and like you guys that trade for a living, so to speak, you can, you have those other things you can use to to search for ideas.
Yeah. Anything else as far as Market Smith? Now, I don't even know if I'm I'm not prepared really for this, so I don't want to say something and put your foot in your mouth. But I don't know. I think you might have a special offer for attendees, right?
Yeah. So
Okay.
if you're new, if you've never taken Marcus Smith before, then we'll give you 15 months of service instead of the usual 12 on the annual. So the price is $14.99 a year. Some of you, it depends on where you're located, whether it's state tax or if you're in Europe, you'll be subject to the VAT, the value added tax. There is a tax. I want to make sure everyone knows it's $14.99 plus tax, but we do offer 15 months instead of the usual 12. If you're new or you're on a monthly, you can change to that. If you're on an annual already, if you've already gotten a promotion for us, then we can't change the 15 what you have to a 15 month. If you have an annual with us and you didn't get a promotion, it was a 12-month. I put the email in the chat just now, marketsmith@investors.com. Email us, and I'll be glad to add a bonus month to your subscription. So it's $14.99 for 15 months is the promotion that we have for Mark's attendees.
And I'll be sending out a flyer to everybody along with, I think we mentioned the certificate. We need to send out the properly updated certificate of completion as well. So you'll get an email, everybody, with these two updated flyers.
And an important part, although we hope that you stay the 15 months, if you use Market Smith for 92 days and decide, it's not for me, then you're always subject to the prorated refund, whether it's 92 days or 9 days or 100 days, it doesn't matter. You always have that option. So you don't feel like, when you make a commitment for 15 months, like, oh boy, I'm stuck. You always have the option of a prorated refund with the annual subscription. Lisa, I'm sorry, don't see the email that he put in. It's the email is Market Smith. So the name Market Smith at investors.com, investors.com.
You only send it to the host and panelists, not to everyone.
Oh,
Scott,
did I? I'm sorry. Thank you.
If you want
Have
to
I
adjust
been
that.
replying in the chat to nobody? Just to
if
you
hit,
guys?
if you hit
I
if
do
you hit
that
the
all the
person's
time.
name individually,
Everyone. I needed everyone.
yeah, everyone.
That'll
I
go out
apologize.
to everyone.
Okay. Yeah, I've been replying to some people's questions and no one saw that. I apologize. I messed that up. But yeah, if you have a question, send us an email, even if it's not subscription related. You won't need a promo code. I think, Bob, you will send them an email with the details.
Yeah, I think I can also even drop, I think, the link we have here. I'll send this to everybody here as well, but we'll send out the email in an email. But this is the link, guys, that takes you right to the special promotion for the Minervini Master Trader Program attendees.
And I don't get a kickback on this, so just so you know.
That is true. But
and
Market Smith at investors.com, guys, as you can see now from Scott, that's how, for those who may already have, as mentioned, the promotion or a membership, you do have the ability to get what would be the one extra month taken care of.
Or just an in general question. Like if we didn't address your question, you're welcome to email us there as well.
There's a question that I know somebody asked if there's the ability to change the bar to candlesticks, or is that coming?
No, yeah. I hesitate to say that it's coming because I don't have any kind of ETA on when, but fast forward long enough, we will have candlesticks.
I've heard that question many times.
A lot of people like candlesticks.
I know.
It's one of the things we get probably the most requested item. So, and again, I don't think I would use it, but it's like the stochastics. Give them a chance to turn it on or off if they want it and go from there. So, but the reason we've stayed kind of in our lane for so long and kind of fought these changes is that kind of legacy, that homage to Bill O'Neill is, this is the way he liked it, and it works so well for him. Why change that? So
yeah. Anything else that you want to show on any features? Or, I mean, we've covered some of the real meat of it. It's very powerful. There's lots of things you can do. But as I said before, approaching it from a more simplistic way where you don't get too complicated in the screens and use the sorting functions, and you sort of layer your screening by having wider nets. You get to see all the names. And, bottom line, Scott, as good as we've all been at, Bill O'Neill wrote books, I wrote books. You guys have, charting products and we have rankings and all these things. We still can't quantify this to the point where it does the work for you. We still got to roll up our sleeves and do some good old fashioned analysis and legwork here. So I think it's important, and I often say that, again, if we could quantify it, if we could put everything into a spreadsheet and quantify everything, then there would be no opportunity because the market would be efficient. And so thank God that we can't, and that it is an art form, and it does require skill. Just like poker, you can know about laying pot odds, and you can know the probability of every hand, but there's still a skill element of it. It's not going to be completely quantifiable because you're in a game against other opponents where the skill of operating is you're going against. And the same thing with the market. Varying levels of skill and information is going to create inefficiencies, and that's the whole key. But everything that I was talking, Scott, over the fundamental section of the workshop. And, I get these questions. I'll show, I use margin, sales, earnings, and I start getting questions on, price to sales, price to book, and all these other metrics. And two things. One, I always say, if analyzing balance sheets was the key to being, a great stock trader, accountants would be the richest people in the world, So, but, what I try to point back is to say, look, my success has been, by looking at sales, earnings, and margins. And that's sort of the net. I mean, if a company's making money and they're delivering the earnings and their margins, you don't really have to look much further. And O'Neill, Bill also kept it pretty simple with maybe return on equity, a few things, but it's all right here. It's all right here. And I think it's important for everybody to understand that this whole system and what Bill's work and my work is not off the top of our head. It's based on not only 100 years of collective trading experience, but also analyzing the stock market and the biggest winning stocks going all the way back to the 1800s. So there's a very, very strong foundation around the this information, and that's why MarketSmith is so great. It gives you everything you need in this bird's eye view. Very hard to get all this information in such a bird's eye view where it's so quick to be able to access exactly what you need and filter out all the noise.
Yeah, I think one of the advantages to MarketSmith is a time saver. Think about your time. There's in our database there's 9,000 stocks, ETFs, etc. There's probably as 20,000, worldwide, if you at least probably more. And how do you get down to a manageable level and find those names? I don't know. I've been a subscriber for years before I came on board. I don't know how I would find it without something like this. Yeah.
Okay. Let's see. Anything else you want to cover, Scott?
There's a couple of questions. If there's nothing going on in the market that you guys want to show, somebody asked about the pattern recognition.
Sure.
So, you see the stock, it's got this cup with handle, it's got this large consolidation, it's got this double bottom. So Mike Webster, some of you might be familiar with him. He is a former portfolio manager at William O'Neill forever, and he worked on
And a great guy.
Building this. Yeah, Mike is a solid guy. And he's gone out on his own and hung his own shingle, so to speak. So he's still involved in the markets, but he was instrumental in kind of programming and helping the programmers to try to understand, what a pattern is, what's the math behind it. And it's not perfect. It's, because it is math based. So, a lot of people might say, well, I see a cup with handle right here. How come MarketSmith doesn't? And I would just say, okay, no problem. Buy it right there if you want. That's fine. It's more of a guide. But if you hover your mouse inside the base, it'll tell you what the pattern is, what the pivot point, the action price, the buy point, whatever you want to call it, how deep the base is. That's actually probably my favorite feature, is how quickly I can kind of analyze the base. How deep did it correct? How deep did the handle correct? Things like that. And then these shaded areas are the money management principles that we use. And it's a guide. It's, here's the 0 to 5% range where you would build your position. So ideally you'd buy half here. If you wanted 1,000 shares, you'd buy 500, you'd wait. It gets halfway through the pivot, you'd buy 300, you'd wait. It pulls back, but it never hit your stop. This is down 5 to 8% from the pivot, that pink range. And then at the top of that box would be 5%. That's where you would add like your last 200 shares. That's kind of the standard O'Neill system for building a position. And then this green area is 20 to 25% from the pivot. So that's the kind of the standard profit taking area where you'd want to consider, selling or all or maybe a portion of it. And that's how these shaded areas are programmed in.
So a few things, a few points here that are good to talk about. First of all, these are guides, all right? These definitely guidelines, but they go together with the pattern recognition. That's something that if you're a beginner, you probably want to use, and it'll give you a good idea of when you're in a base. If you put this in connection with the my trend template, now you've got stocks that are in uptrends and are in bases. Now, I know there's a question about the measuring tool. There's the measuring tool that I use in the eSignal program. That they don't have the measuring tool here, but as Scott shown, you could hover over and it'll show you the depth of the base and the handle. So that will give you that some of that measurement that you can decipher in the volatility contraction, those iterations. So with that, and the fact that you're seeing where the bases are and they're in uptrends, and then you've got overlaid where you pyramid your position and where you would have your stop loss based on a maximum of 8%. You've got some real good guideposts here to at least get you in the ballpark and really not get you too far off track, because that's in the beginning. There's going to be a lot of variance in how well you do this, because you haven't done it very long and you're not very good at it yet. So you need to have these reference points, and they're very important.
Somebody asked about exporting. So if I run the screen that we built, the results are going to show up down below here in that list panel. And if you want to export those results to Excel, you just click on this wrench this time in the bottom right corner, and you'll see export in. Excel 9703 Excel. I find either one of them works. You just click on one of those. And
a quick hack also is if you just make a new screen and then the screen comes up and it'll be blank, you can cut and paste. If you're in Excel spreadsheet, you can grab a whole bunch of names if you want, and then just hit Control V, and it'll populate this. So instead of importing them in, you could actually import them that way too if you want to cut and paste them in. That's sort of a little quick way to do it that I use.
Correct. Yep, it works both ways if you had them already. So depending on your browser, most browsers dump into the bottom left corner. You'll see I'm using Edge. Edge creates this little download folder up there. And so that's where you'd find the results.
Yeah.
Last but not least, I think as somebody asked about the trend line alerts. So you can draw, I don't know, let's just say for whatever reason you wanted to know if Amazon broke this little downtrend right here. So step one is, and I'm using a PC, so it'll be a little different for a Mac. I think it's Command is the key, but in the bottom left corner of your keyboard is the Control key. Hold that Control key down and just drag your mouse where you want the line to be. And these are all temporary lines. So if you don't like it, you just do it again, or just refresh the chart by hitting the daily button so that it goes away. But once you have the line how you like it, if you hover your mouse over it, you'll see it creates this little dull yellow background. And now right click. Don't fail me now. Thank you. Okay. And here, let me turn off the pattern rec. Sometimes with the pattern rec on, it loses its mind. Oh, I just got too impatient, too much clicking. But if you, okay, so we draw the line, hover our mouse over it. Eventually we're going to get this. I promise.
Okay.
Right click, set alert becomes an option. You'll get the little pop-up box. It says symbol Amazon win line. D stands for dailies, because I'm on the daily chart. It's going to create a daily trend line alert. You can do it on a weekly or even a monthly. Do you want an email notification? Yes, I prefer to get it. You can turn that on or off. Hit done. And then the line will change to a dotted black line, and that's a live alert. And it will follow the stock down. So eventually, pretty much, especially for a stock like Amazon, as this trends down, eventually it's going to cross above it and the alert will go off. You'll get the little pop-up bell here, and it will say Amazon crossed above your trend line, or you could do it below if you wanted to do it that way as well. So yes, it will follow the stock along the whole way. if you have Marcus Smith, it gets a little buggy if you try to set the screen. I'm sorry, if you try to set the line alert too far to the right, just an FYI. So just draw the line however you want. It will extend it all the way out. It'll follow that stock the whole way. So you don't have to worry about getting that line so perfect. Yeah, Rick mentioned in if you're having issues with this, and it is a little buggy, we are troubleshooting it. So I hope to have this resolved, because this is a big deal. My favorite way to send an alert is with a trend line alert, because everybody has a price alert. I can do a million price alerts with my broker. So I like trend line alerts. Try clearing your browsing history and cache on your browser and then reopen the charts. That could help if you're finding this to be a little buggy. And then the other thing is turn off the pattern recognition. If you try to draw a trend line within the pattern recognition, it kind of loses its mind. It's not sure if you want a trend line or if you want an alert based on the pattern, because you can set an alert based on the pattern. So those are a couple of tricks anyways, until we fix it. And hopefully we'll get that fixed. It's not so unuser friendly.
Okay, Scott, great. Thank you, man. Appreciate it. We covered quite
Thank
a
you.
bit. Yeah, we covered
All
quite a
right.
bit on Market Smith. Any closing comments or anything?
I don't. I really appreciate it. Thank you for allowing us to be a part of your events. And again, if you have questions or want to take advantage of that offer, the Marcus Smith email, and or I think Bob will send you an email with a link on how to process that.
Okay, great. Awesome.
Okay.
Yeah,
Thank
man.
you, guys. Have a great week.
Thanks, Scott. Talk to you.
Bye.
Okay, great. So now let's see here. Let me go back to sharing my screen.
And real quick, Scott, before you left, I was going to say, okay. I didn't know if he was going to hang out or wanted to hang out, but he's more than happy to.
Oh yeah, certainly welcome to. So we got ADM is moving up a little bit more here, so that's good because it's offsetting my my loss on the as Gordon Gekko would say, the bow wow trade.
Dog with fleas.
Dog with fleas. If we take a look at ALNY, so now ALNY is moving lower here. So again, on the intraday, like I said, looking at this as this was a daily, you see the violations. Once the violations started piling up and you got all those lower lows, it wasn't acting natural now. And now it's corrected even more here. Now, of course, on the daily, this isn't really a big deal. We're magnifying it on the intraday. This is exactly what we've seen over and over. It's stalling out exactly where it should. If it's going to stall, this is where it should. But still, it's fine. I mean, if you're swing trading, you should not be selling this. And let me just point this out here. If this could hold up here, even if maybe it has a bad close around here today, comes off another day, well, as long as it holds up, it tightens up a bit here, you could be looking at a better setup in a couple of days from now. All right, let me show you. Oops, sorry. This here. And this tightens up a bit. Now you get a reversal recovery, take out that reversal, and you come from an even tighter pivot. And now that's just, once again, just another iteration. You got the first here, right? From here to here. Oops, sorry about that. From here to here, from here to here. And now you have just two more. Now you're getting real tight there, right? That would be perfect. That's exactly what we want to see. And preferably we want to see that during a weak market. Like if the market came off here, let's say over the next few days, the market corrects. And when I say the market, I mean the indexes, and the Dow comes in, but during that time, this stock goes real tight and the volume stays real low. Well, that would be something I'd be even more interested in. Even though I just got stopped out of it, I'll go right back into it. I'll re-enter it if it can break out. So this may improve. And we just may be a little bit early here, but we don't know until in hindsight, we don't know, because this still met the criteria here. So once it starts tightening up and gets that single digit, we could start taking a position. But again, until we see some traction, until we start getting some traction and seeing stocks work and seeing a proliferation of these type of setups working, we want to be careful and just go in light. So yeah, we're moving up here. Also, ADM's moving up a little bit more here, only up a couple percent. But like I said, this is moving in the right direction now. The intraday is acting very good. You can see little natural reaction, formed a little mini VCP, little natural reaction, boom, right into new high ground. And now we're accelerating here. So far, so good. Volume, if you take a look at the volume, we're at 12 o'clock. That's actually pretty good volume. You can see we're about 2/3 of the way to average volume. This could easily be above average volume here. So I like what I'm seeing in ADM, ALNY. Unfortunately, ALNY was the one that I bought a bigger position in. So, but it would be nice if I had the 5,000, or I guess equivalent, the 5,000 shares in this one than in the ALNY. But again, offsetting, I took some off into the rally that banked a little bit of profit, cushioned me a little bit, and now I'm up on this one. I'm up about $1,300 on this one. So this is cushioning the hit on the ALNY a little bit. So again, if it just trying to finance that risk here. What else? Let's go. What we can do now is why don't we go? It's 12 o'clock, 12:15. This is where we get into usually a more quieter period around lunchtime in the market. Maybe we can switch over to the workbook now and start going back to some questions that you have about, because we had some curriculum on day 4, of course, that we didn't have a Q&A. If you have questions on that. So let me just, I'm going to change I'm going to stop sharing. Or actually, you know what? No, I'm going to share. Hold on. Sorry about that. I'm going to share.
Workbook.
Yeah, I'm going to go to the workbook. Yeah, I'm going to share. Then I'm going to open the workbook here. Let me just set this
Mark,
up.
I also don't
I'm
know.
just going to show you the PowerPoint so you can see the PowerPoint, and I'll work from the PowerPoint. That'll be an easy way. And I'm just going to move this over to fill your screen.
Yeah. Did you, I don't know if you
actually do this. Hold on. I can actually just, let me fill the screen so you guys can see it. It'll be a little better here. Okay, there you go. That should be
yeah, it's pretty solid there.
hold on, I'm going to get it where it fills the whole screen. So there you go. Okay, so now we're in the workbook. Okay, go ahead. I'm sorry, Bob. What were you saying?
I was going to ask if you wanted to have, I don't think we technically set a lunch time of any kind. It's kind of, guys, we're going to do what we do, but
yeah, well, we're not taking lunch. So
right. So just to let everybody know, we don't have a set time for a lunch break that we're not going to be projecting.
Didn't Gordon Gekko say lunch is for wimps? Anyway, no, we're not taking lunch, but I haven't even had breakfast yet, so I'm gonna try to get my wife to bring me something over here and bring me some food here.
Had a lot of questions, really, as you might imagine, with regards to progressive exposure. People essentially asking, when do you start pressing it? What if you have paper profits but not realized profits? Do you still increase your exposure there? At what point do you start? Would you bring it back down if you take one loss or 2 or 3? So yeah, a lot of questions about progressive exposure, as you might imagine.
Okay, so first of all, let me just say this, that and Mark, I'm going to bring you in on this too, because we haven't heard much from you. And progressive exposure is something I definitely would like you to talk about. Progressive exposure is a few things about progressive exposure. First of all, it is one of the absolute most important techniques or tactics that you need to understand, and that will make the biggest difference in your outcome, in your success or failure. It is without a doubt, for all the successful traders that I've worked with, that I've trained, they always come back to saying that was one of the absolute key things that made the biggest difference. Now, with that said, it also has the most subjectivity, I think, or it is the least of exact sciences. And we're going to go back here. The bottom line is that it has to be relative to your own size. You kind of start with what your maximum size would be. So just say if your maximum full position is 25%, that's sort of the starting point. Everything's based on that. So that's your starting point. Generally speaking, I'm going to trade at a quarter to a half of that full size and expose from there. So if I'm just starting to get into the market, I might take a quarter. I mean, and then it might even be just like today, it's just randomly, I just decided, X amount of dollar risk. I'm going to go in 1,000 shares. Let's just say, it's $2 to the low. It's $2,000 risk. I sometimes just make decisions like that, and that's fine, especially when you're trading sort of to keep your finger on the pulse. It doesn't really matter as much because you're just trying to put some money on the line and trade in under real conditions, but you're just getting feedback. So, Mark, why don't you? Is he here too? So I got him off the screen.
Yes.
There you are. There you are. Okay.
Watching and waiting.
Yeah. So, this is the same question we get over and over and over and over. When do you press it? When do you pull back? How many trades have to be profitable before you bump up? How many trades, what percentage do you bump up? And again, maybe someday I'll do a better job at, quantifying this a bit more and having more of a strategic, black and white answer to that. I don't think so, though. I think it's because it's so built in, it's so based on the individual and this is really, part of the art form. But the key is to get yourself to trade the largest when you're trading the best and the smallest when you're trading your worst. That's what you want it to guarantee you, that as the trades are working, you're moving your exposure up, financing the risk. And as they're not, you're getting smaller. So you're not losing the same size or bigger size. When you're losing smaller and smaller and smaller. So if you get into a trending period, you're trading your absolute smallest, so you're in cash. That is the real key that you have to understand. But with that, Mark, as far as any kind of guidelines or rules, where are you at with that, and what would you recommend?
Yeah, I mean, look, this is really the part of this strategy that is the art, in terms of, but it's not that it doesn't have a very firm, science or mechanical, if you will, scientific underpinning. The idea.
I'll be right back. Continue.
Sure. Yeah. Go grab some food or whatever. So a couple of things. The one I would say is I always want to know what is actually going on in my trading, meaning, so let's just say, hypothetically speaking, I've got a list of 5 names. I buy one, it doesn't go anywhere, and 3 others blast off and I didn't buy them. Maybe I bought the first one, broke out, and it squatted. And so I didn't buy another one. Well, I'm going to take the fact that the names I own, I don't have anything to lean on. I'm always looking to build up a cushion to lean on. I know we had a question, Bob, you said about, do you wait for booked profits versus open? Generally speaking, for me, I'm always leaning on open profits first. So I want to use that first bit of traction as something to, as building in some padding for me to buy a little more. But that doesn't mean that I'm necessarily going to let everything just stop me out and clobber me right away. I might move some things up or make some overall portfolio decisions right then. But so the 2 big things is, what is happening in terms of my actual trading, and then where are things on balance? So the more you do this, you're going to have a list where you never buy the whole list, just by the way things work out. So you might have a list of 10 names, 20 names. Today's a good example. If you bought everything that poked its head out, ask yourself that, where would you be? You'd be underwater today. So I'm using that also as to say, at some point, we're going to be in a period where, and for those of you guys who've been doing this for a while, know exactly what I'm talking about, where a majority of the names that we're watching are acting well, or they're breaking out and holding and moving higher. So even if I'm only in 2 of them, but things on average across the universe are really acting well, that gives me, again, additional confidence to bump up size. But I am not, if I haven't earned the right in terms of my own trading, it doesn't matter how good everything else in the universe is trading. And there have been times where I buy 1 or 2, I buy a couple of the names that don't move, and a lot of other things blast off because I buy in the order of breakout, and maybe the first couple of names that pop their head out don't really get going, or you kind of have to continue to jockey for position. That is the best analogy, though. The idea of jockeying for position is you're sort of in the pack trying to figure out, how to maneuver. You don't necessarily know exactly, how to, position yourself right away. So that's how I think about it. But I'm never, ever, ever increasing without some form of a cushion. And for me, though, that is almost always open profits first. I don't wait to book them to at least get more aggressive initially.
One thing I was going to add
Sorry,
to that.
I'm muted. I'm sorry. Let me just say something real quick. I like that earn the right. I'm going to use that and put that in the PowerPoint here. Earning the right to trade larger. That is great. Yes. Have you earned the right? It doesn't matter what's happening in the world around you and the stocks that you're not in. It matters what you're in, because if stocks are blasting off, but your trading is not producing the results, you've got to manage that risk because you are now in the hole. And so that you can't trade larger just because the market looks good or whatever. You've got to earn the right. I love that. Go ahead, Bob. I'm sorry.
I was just going to say, I think I get this question asked, over all the years, probably more than almost any other question, but it really comes down to, as a lot of times, is your individual risk tolerance. Mark are very happy or comfortable perhaps risking what would be profits, even paper profits before. I know some people are more conservative, would rather have locked in profits before they escalate. So that's why we always talk about the pillow factor. We have to do what you're comfortable with so you can sleep comfortably at night. And it can be frustrating if you use previous profits to then increase your exposure, only to have it get lose that back on the next trade, because in the example there, you're losing back the $1,000 that you made on the first trade. Mark's okay with that, because if he catches the market just right, it's going to lead to that second win, that's the third win, and accelerate it. And if he gives it back, it's nothing lost, nothing what's the expression you use, Mark? Nothing gained, nothing lost, kind of just a push. And that's something he's comfortable with, but some people are not, and complain and get all worked up when they just lost everything they just won or made in the first wave of trades. So that's the thing where it is an individual decision to really understand what you're comfortable with.
On another point too, just on position sizing and so forth, you see today, I went and I bought 1,000 shares of ADM. I bought 5,000 shares. So I bought a much larger position size. And now the one that I had the large position size, was the one that stopped me out, and the smaller position size is the one working. So, and this is another question we get all the time, as far as should you take equal position sizes or have favorites and so forth. It generally comes out with me. I'm a professional at this, and I'm going to I have such a consistent application of discipline that it comes out in the wash. I may have done that today, and tomorrow it'll be just the opposite. I'll position size big on the one that'll work, and the one that I position size small won't work. So my intuitive gut is pretty good at this. And even though I may not get it on any one day right, over time, they sort of just all come out in the wash. But you should probably try to be more mechanical with this and develop some type of formula based on your largest position size, and maybe cut it in half, quarters, and then just negligible, sort of just keep your finger on the pulse, what David Ryan calls mental health buys, just buying a little bit in case the stock takes off, and being involved. I would try to break it down into those tranches and sort of have a formula, some plan that you stick with, instead of shooting strictly off of your own emotions or having favorites and things like that. It's going to take a long time before you get to that. And even with myself, I try to keep my position sizing as standard as possible. When I start trading, and the way I do it, to be honest with you, the way I do it is I just try to work up to the biggest positions I can possibly get on. That's sort of how and that is really when I'm making money, big money. It's when I've got the big positions on and I got the big exposure. So that's what really matters. Everything else is sort of jockeying for position and treading water and making a little bit, chipping up a bit to have those profits, to be able to get aggressive and keeping the downside in check. So again, what's really important, and then once I do trade big, all the positions are pretty much the same, because I'm just putting on the max that I can. That's what Mark and I are trying to get to. We're trying to get to that point where we've earned the right to be as George Soros and Stanley Druckenmiller said, be a pig in the market. You know, I'm a chicken most of the time, but every now you got to get piggish every now and then and get in there and be greedy, you know, and you put the big positions on and make hay when you may. So, but that's a very small portion of the time that you're in the market. You know, if we're averaging 50% out of the market, and you know, it might be 10 or 20% of the time where you're really super aggressive. And but that's the upside. Like that's the benefit of being exposed only minimally and making a lot of money with not having exposure all the time. You don't want to be exposed all the time. I just had a nice big plate of eggs delivered to me here, so excuse me if I eat in front of you.
Question being asked if you ever use a time stop versus just purely a price stop, because he finds he might be in a trade, other trades are setting up and breaking out. He doesn't know if he should close the trade that's not working to put the money into a new breakout.
Well, you got to be real careful with time stops, because just because a stock hasn't gone in X amount of minutes or days doesn't necessarily mean that it technically has soured. As a matter of fact, like I just showed you in a few of these examples, it could improve, and time is your friend. So I know some traders, actually a couple come to mind that came to Master Trader Program that are massively, massively successful. And both of them, there's two in particular that do use time stops. They use it when they put on the trade. So like, for instance, the ADM trade, they go into this trade today. If it doesn't go right away and it stalls, they give it X amount of time, call it 2 hours, 2 minutes, whatever you want to call it. Then they say, okay, I didn't time it right. And they get out, and then they look to re-enter. That's, you know, a very expert approach that you have to, again, if you have re-entry mechanisms and you're nimble enough and you're in there watching this all day long and you're trading more professionally, as opposed to, you know, you're part-time and you have a job, it'd be a lot harder to do that. So I'd be careful with that, but it certainly has its place. I look at the time factor on the chart. Is this time too long on the chart? Is it abnormal? So I relate everything back to the chart. The chart tells me everything. Now, as my good friend Stan Weinstein says, the tape tells all. And I agree with that. Pretty much everything.
Somewhat of what you just talked about a moment ago, Mark, the question was related to that, so I want to ask it. In what this individual is experiencing, he'll have a couple of successes with the smaller size trades, then he steps it up and has the one loser wipe out what was previous gains, because he wasn't doubling, he's just incrementally increasing. So his question is, his stats look good because having a couple winners, but on a dollar basis, he's still at break even, showing no progress. How do you handle that, or how do you deal with where your stats may look good on a percent, you know, statistically, but the dollars are not reflecting that?
So that's only because you haven't been in a really strong trending environment. I know just by what you're saying that you haven't been trading in a strong trending environment yet. And so you're in a sideways action market where the aggressive exposure is doing its job. That's precisely what's supposed to happen. And it's frustrating because you're not making any progress. And then you very quickly give it up, and you're zagging when you should zig and zigging when you should zag. But that zag zig is actually the proper zigzag. It actually is that is the right way. That's the cost. See, there's a cost. Everything has a cost. There is no free lunch here. All right. If you sell the stock soon, you risk a bigger move, right? If you take the small profit, you know, then if it goes higher, you miss that bigger move. You know, you sell the stock at a loss, it could turn around and go back up. There's always a cost associated. So, but that's the cost for making sure that you are trading small when you're trading the worst and trading large when you're trading your best. So now, okay, let's say the market gets into a real strong trend now, and you do that same pyramiding up, and now you get into that trending period, you're going to be guaranteed that you're trading your largest when you're trading your best. And that's the job of it. But there's a price to be paid. And in a whipsaw market, yeah, it's going to be frustrating. This is why people say, why isn't everybody doing this? Because it's not that easy. It's really difficult. It's difficult. First of all, you got to have the knowledge. You got to develop the skill. You've got to be able to control your emotions and have discipline and deal with all these things that are counterintuitive, and then deal with these long periods of time where it seems like it doesn't work. But you have to, after a while, you learn that that's part of it, that not working, all that boringness, trading is boring. The 90% of the time, it's very boring. You don't want the hair on the back of your neck to stand up when you're trading. Did you see how calm all the trades I just did? Like, there's no big emotion. I put on the trades. I know exactly where I'm getting out. I know my position size. I bought $600,000 worth of stock today. If I bought $10 million in a position today, there would be the same exact emotions. There would be none. It would be emotionless, because I would already have my risk defined. I've got a plan, and that's the way it needs to be. I'm not looking to get excitement. This isn't for. I want to get excitement. I go drive my Lamborghini and go race around a track. That's for excitement. When I go to Vegas and roll dice and have fun. This is about performance. And if you want excitement from it, that's fine. You can get it. They'll give you a lot of excitement if you want it. But that's not, you're trying to develop this into an unemotional, very systematic, methodical strategy that achieves the goal of putting you in a position to make lots of money when you're right and minimize when you're wrong and create asymmetric leverage always. Mark, you have anything to add to that? And once again, this zigging and zagging, this is the most common thing we hear. Well, I ramped it up and then clobbered. And then when I trade small, then the stocks take off, and this progressive exposure isn't working. It's working perfectly. That's exactly what it's supposed to do, right?
Yeah, it's like it's a feature, not a bug. What was just described there, the idea though is, if there will be plenty of times where you're going to jockey for position only to get out, with a tiny gain, right around break even. But if you were able to, increase your exposure without taking additional risk, and do it properly, just think about how many times you could do that, and then you really nail the timing one time. It will more than pay for all those other times. And that is very difficult though for some folks psychologically, especially, well, I had a couple of winners and then I gave it all away. Well, the idea wasn't to make a little bit, it was to be able to position yourself properly with a small initial risk to make a giant step forward in terms of your P&L.
Hey, another thing. So let me show you. This is what when you're trading stocks, you're trading stocks that look like this, basically, right? They look like this. That's what your equity curve should look like. See, so when you're in that phase where you're getting whipped around, this is what happens right here. Yeah, and this may go on for 6 months, a year, right? But you see, the one thing that's happening here is I'm not losing any major ground. Yes, a lot of frustration in here, but not much ground being lost. And even if it was maybe, was down a little bit and you are getting grinded away a bit, still you're minimizing and putting yourself in a position for the big move and being fully invested when things are working. Just like a stock, your equity. If you were to look at Mark Ritchie's equity curve, look at my equity curve, you go through basing periods and then sharp up moves, and then basing periods and sharp up moves. And very seldom are there any big drops. And if there are big drops, and matter of fact, I looked at your equity curve, and whenever Mark Ritchie's equity curve had a big drop, it flatlined, which showed that as soon as he got under pressure, bang, he went to cash. And then it just flatlined, and then it slowly moved back, and then it accelerated. It was perfect. You could actually see the progressive exposure in the equity curve. I could look at somebody's equity curve. You show me your trading, show me your equity curve, and I'll tell you everything about the trader. Matter of fact, Mark, you remember that's us, but you didn't tell that story.
I didn't know. Yeah, I thought that one was maybe overplayed in years past, but I'll tell it again. So, in the very actually, it was after the first master trader program, because I had sent Mark I think it was 6 months of trading or something to win the triple digit challenge, and he did a webinar, I don't know, a few months later, and we didn't really know, we shaken hands in person and said hello. That was about it. And so, sorry about that. He started to describe me in what I felt was rather, somewhat personal manner in terms of my personality and certain characteristics and who I am. And they were all accurate descriptions, so much so that my partner Brandon was like, how in the world does he know that stuff? It was a little bit eerie, almost like somebody was, reading your palm or whatever. So then when we were together a number of months later for the next Master Trader program, I just brought that up. I said, that was kind of a fun trick you played there. How did you know all that about me? And he said, I've looked at all your buys and sells. Your trading is nothing but a reflection of who you are and your personality. It's all there. So, and I can't remember the comments he made specifically, but he's like, I can tell Mark Ritchie is not, he's very disciplined and he's not very emotional in terms of his trading. He said a few other things, but the idea being that your psychology and who you are is reflected in terms of the way you buy and sell in real time.
Yeah, if I look at an equity curve, I mean, I've trained thousands and thousands of traders. I've worked with thousands of people over the years, over 40 years, have had hundreds work for me. And I can look at an equity curve. I can look at someone's trading, and just like with aces, I can't tell you if you're going to win in any particular hand, but I can tell you, aces are going to win over. It's a winning hand. I can look at an equity curve and know this trader is a losing trader. This trader is going to blow up. This trader is doing everything right and is going to be a superstar. I know what a superstar equity curve looks like. You give me, maybe not in a month or two, but show me years of trading of somebody trading, and I'll tell you, I'll foretell the future because it's all right there. And it all comes down to managing the risk versus reward. So it's the exact same thing as what you're trying to accomplish with the stock. It's the same principle. You're putting yourself in a position to have this upside by capping the downside and creating the asymmetric leverage. All right, let's we're supposed to do questions on the workbook here, and we got stuck on progressive exposure for quite a while.
Yeah, well, there was a lot of questions on that.
Yeah, I know it's a huge topic and everybody asked, so it's good that we did, but let's move on.
And then there was a related question to what you just described. I'll just ask while I'm getting the questions on the specific pages, but and now I just lost it. All right, I'll come back to that. Bear with me. 454.
Hold on one second. I just have to 454, did you say?
Yeah.
Gotcha.
Question was being asked if you can just review again how you're adding more shares, but with the same amount of risk.
Okay, so again, when you take your first position here, obviously it's all risk. You're risking $1,000. You're risking $1 on 1,000 shares, so you're risking $1,000 is your risk, right? As the stock moves up, and we're just going to call this a low cheat or a cheat, and then you form another pivot within the base, you get another buy point. As you add shares here and you move your stop up, the new stop becomes a backstop. It actually becomes a trailing stop on your profit and a stop loss on your new shares. So now at 1850, you add 1,000 shares, right? So you have 2,000 shares now. So you have $1.50 stop at $17 on 2,000 shares. But you net this all out, the profit that you have and the risk that you're taking, and you're still risking $1,000. If you get stopped out, your net loss is $1,000, but you now have 2,000 shares on. So if the stock goes up from there, you are now levering up. Your upside is double, but your downside is still the original $1,000 risk.
One question was asking on 430, don't have to pull that up, but on the tracker spreadsheet is asking how you accommodate or adjust for half size positions versus full size positions, because this does not take into account weighting of your trades.
Yeah, that's a common question too. I don't weight them because this, I look at it this way. This is when you look at your largest gain, your largest loss, you look at your average loss to gain, that's your decision making based on where to get out, where the chart sours and the mathematics behind it, risk reward. Position sizing, yes, is another aspect of it. And obviously, if you were taking big positions on the big gains and small positions on the on the smaller gains or vice versa, that would affect things. What I found, and I used to track it and weight it. I know Mark does weight it. He does weight his results, and when he analyzes the results, he weights them. I weighted them for years, and I found that it kind of comes out in the wash, and it's just more pure to see the decision making versus the weight. Now, the weighting, if you want to do a separate table and say, okay, well, I want to see if I'm making good decisions on, position sizing. Well, again, like the previous person said, in a whipsaw market, that's going to look bad. In a good market, it's going to look great, because now the positions that are big are going to be your big winners. So it depends on the environment, whether that's going to bear out and look like it's working or not. So you have to know that. So everything comes out in the wash pretty much. Sometimes I'm going to have the bigger positions and a better name. Sometimes I'm not. But I found that it really comes around an average, and I've never seen it to give at any value to track it that way. So I stopped tracking it that way personally. We do not have that in our own tracking. We do not have that. We'll probably at some point add that feature where you can put position sizing in and then get that net result, sort of like the adjusted win-loss ratio, adjust for position sizing. We will add that, and we are now working very quickly. For those of you who are members and have used our software, we're right now working furiously on Monolert. And once we get Monolert to a certain point with charting and a lot of really cool features, we're then going to improve trading logger, and then they're going to be tethered together even in a more impressive way, where then they all work together. We're going to have a lot of ways to slice and dice the information. So we're going to have a big leap in the technology over the next 6 months of this next year in 2023. But I personally don't use it. Even when that capability, I probably won't utilize it.
Question on 469.
469, yep.
As you increase your exposure, do you still keep overall risk to a total of 1.25% to 2.5% of your total equity? Do you keep risk to total equity even at 100% invested? Not sure why one would make a difference.
Risk of total equity is on your
Per
position,
trade.
at each position.
Yeah, maybe that's the problem. They're not understanding that's a per
Right.
position.
Right.
Yeah.
It's on your position. So if you were to take a 12.5% position, if you have a 10% stop, well, that's 1.25% of total equity, 12.5 divided by 10. If you were to take a 50% position, well, that 10% stop would be 5% of total equity. So you wouldn't be able to do that. So you'd have to cut to maintain that 1.25, you'd have to take your stop all the way to 2.5%. So either your stop has to move or your position size has to move. They work together in creating your risk of total equity. So then your total exposure, that's based on how many positions you put on, but you're still, if you have a certain risk of total equity, well, that's your risk of total equity. You understand? That's each individual trade is what you're basing it on, though. Because this is to help you with the risk of ruin if you get stopped out of a bunch of stocks. So that's why on each individual stock, you only want to be risking X amount of your total equity. So it has a certain level of impact on your overall portfolio. Too little of impact, you won't make any money. Yeah, you won't lose any money, but you won't make much money. Too much, you can make lots of money, but the risk of ruin, if you get a streak and you happen to have 10 trades, 20 trades that are bad, or maybe your batting average goes down to 20%, the last 20 trades you're only right 4 or 5 times, you can blow yourself up because now you're risking too much. There is an optimal level, and that 1.25 to 1.5 is sort of a sweet spot. 2.5 is the upper end. Anything below, you start getting, below 1 or 0.75%. Now you're getting into pilot buys, and that's not where you want to be optimally when things are working.
Page 494.
Yep.
Just a quick answer. The question was being, if they were just using the 8% at 13, not compounding. So that answer, guys, is when you do a compounding. So if you have a 2%, 25% position sizing, 8% return equals 2% on your portfolio, but your portfolio is growing with each successive winner, that's what will get you to the 30%, not just a straight line using the same original starting amount. So
A
Norman.
25% position times 8%, 13 times compounded is 30%.
Yeah, so that's what that is. Norman also was just asking if you can try to explain again the concept of the saving bets can be a game changer from the mind blowing math.
The saving bets. Yeah. And
On
we have,
page
and we have a
501.
line. We have a line
Or-
through here because there was a typo. We talked about this last night, Bob.
Oh yeah, let's
yeah.
clarify
So
that.
this actually should be 2040, right? That's
Right.
2060 is 2%. It's supposed to be 1% more. But the concept of saving bets is very simple. You know, again, if you're breaking rules, this is just showing that if you're buying beyond the buy point, and let's say I'm saying where I'm not going to buy more than 1%. Okay. So we're still going to stick to the same sell rules. We're not going to change our sell rule, whether we bought it 1% above the buy or 2% of the buy. Doesn't really affect the sell rules. So let's just say we sell at 6%. Well, one trader buys it at 2020, sells it at 2120. The other one buys it at, in this case, 2060. 2040 is the math, though. 2040, which is 1% higher. Okay, it doesn't sound like much. It's just a 1% slippage. But now do that hundreds of times, and it's a colossal difference because that adds up. All those little. Now that's just on the buy side. What if you have slippage on the sell side, and you start breaking these little, because it's a slippery slope. Once you start breaking rules, you break more rules, and before you know it, you don't have many rules, and the catastrophe strikes. So the whole point of this is to point out that the little things, as Mark said, it's the little things that add up because it's over time. It's just like an airplane. If you take a plane, a jet that goes from New York to LA, and you just put it off just 1 degree, well, in a very short period of time, it goes pretty much on its course. But over a long stretch, it'll be up in British Columbia. It'll be up in Canada, because and same thing with a bullet. You shoot a bullet, if it's off a little bit, the further you go, the further it goes away. So these things add up over time, and that's why you have to think that you're not going to just make one trade. You're going to make lots of trades. So these numbers are going to distribute over a bell curve, and that tightening all this stuff up and having a really, really tight game creates the champion results.
Question being asked: if a stock had historical a lot of volatility, even though it is setting up properly in a VCP now, does that affect your decision to trade that name, being that it has had historical volatility in it?
That is about as vague and hypothetical as we can get. So I really can't. I'd have to see the chart. Look, the bottom line is the chart tells it all. If it has the chart and the chart meets the criteria, well, that would assess that volatility. Assessing the volatility that's why you have a chart. The reason why you're looking at charts is to assess the volatility and lack of volatility. So you got to look at the chart. If the stock's in an uptrend, see, don't overcomplicate this. All right. Stop trying to get all these answers and just focus on what to do. Don't worry about what not to do. There's 100 million things not to do. There's a handful of things that you need to do. You know what you need to do? You need to look for stocks and uptrends, look for bases, VCPs, tight right sides, single digit tight right sides. And when they get above that pivot point, buy them. Take small positions. When things start working, raise your exposure and do the opposite on the downside. That's what you need to do. That's it. Now that could take a lifetime to become as good as me at doing that, but that's what you need to do. It's simple. It's straightforward. Is it easy? No, but there is no magic answer. Those are the things that you need to do well.
Okay.
All that takes care of everything else. That takes care of everything. Takes care of the valuation. Takes care of everything. It's all going to work out. You know, it manage that risk versus you're going to be in, as Paul Tudor Jones said, I'm going to buy stocks to go to zero and sell stocks to go to infinity. There is so much wisdom in that statement that backdoors the Holy Grail, because what he's saying is that there's this much upside, there's downside to zero, but it's you cutting the middle and managing the downside to the upside. You don't need infinity. You just need more upside than downside. And you need to be able to do it enough times to get to your goal. And the upside is going to set as the pace car, and that's going to set to tell you where you need the downside to be. The percentage of winning, the average gain, and the percentage of times that average gain is going to come to fruition. Once you get an idea of that, you don't even have to know exactly. If you have a good idea that I'm going to have 10, 12% on the upside, and I'm going to write 40 or 50%, the downside is a mathematical calculation now. There's an optimal number. It just becomes a simple mathematical calculation. Now you take that risk factor and you back into trades. You back into trades that fit that risk profile. That's the whole thing. That's the whole thing in a nutshell. Those who understand that and are able to crystallize that and to put that into practice, like Mark Ritchie has, become very, very wealthy from this process. Those who don't end up usually giving more money to the market.
Questions, Mark, just not on a page number, but I have had a number of people who are with full-time jobs, not able to look at the market and watch the market throughout the day. And even people from, Australia and such, where they would be sleeping when the market's open. What would be your recommendation for them as far as placing stop loss orders with brokers, buy stop limit orders to make sure they're not chasing gaps and things like that?
You're just going to have to use the technology to be able to, Mark, do you have any suggestions for that? I think you know more about the platform and the parameters. I'm sitting in front of the screen, and so are you all day, and we don't have that issue. But I don't know. Do you have any suggestions for that?
Yeah, I would say, for starters, you probably want to focus on a little less activity in general, right? Because you're not sitting there in front of things. So I would say that tends to be a little bit more lending itself to swing trading, or even swing trading and then playing names for a bigger move versus the shorter term trading and that type of thing. But I would use some type of stop limit in terms of for entries, not for exits. I wouldn't do that. But if I wasn't going to be around and I wanted to make sure I'm filled within 1% of a pivot, I would have it triggered and then only fill up to the point I want to. That way, if it gaps above me or through me, I'm not breaking discipline. As far as getting out, I would not use stop limits because I want out. So yeah, I will take
right back. I gotta go for 1 second. You guys continue.
I'll take the slippage on an exit to ensure that I'm out, but on an entry, I would be a little more stringent.
Yeah, I think that question actually was asked by more than one person. So when stops are triggered, guys, you want to be out. And if you have a limit order where you're saying I want to sell, if it triggers this price, but only to this amount, what happens if the stock blows right past it and just goes down, 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 down? The quick or the old cliche is your best loss is the quickest loss, right, Mark? or your first loss, and getting out and recovering and being able to get back to focus on that is going to save you way more time and energy than the idea that you may be trying to save what is just a few difference of sometimes pennies that prevent you from being able to get out, even if it's more than 10%. It's one trade out of what might be hundreds or thousands of trades. As Mark mentioned, in his 40-year career, it does not happen all that often, but when it happens, of course, it's going to sting, but it's just one trade out of many, many, many that you'll be experiencing. Let's see if I can get a couple questions that won't be page specific. So without Mark there. Bear with me. I got to get to a different list here. Can Mark Ritchie discuss having his specific techniques for re-entering all or part of positions when he is jockeying for a position and reduced either on a squat or closed below the 20 period moving average? That's the detail I always struggle with, where reducing risk, the worst case often is the right move, but lack the ability to re-enter or add back to the reduced portion when the original stop was never hit.
Good question, and there's nothing different than we just presented. Meaning, so I'm looking for some type of, failure reset, like we discussed, or an improvement in the pivot. Like Mark's ALNY is a good example from today. The stock squats, you can decide to sell it. You don't have to if these are the decisions you generally want to make beforehand as well, guys. So that removing those degrees of freedom on the fly will, in my opinion, will help you make better decisions in real time. But there are plenty of times if you're going to be jockeying for position and I decide to cut a name, it might turn around. And this is the whole point of the Hardaway crossover. Sometimes the name leaves you in the dust. There's not always, a re-entry possible. The key is to have a plan. To know what you want to see in order to get back in. So sometimes I might step aside. Let's say the name just pokes its head out and then pulls right back into the range. And I don't like the way say the action in that stock and other trading, I might cut part of the position, but then set an alarm at that high saying I'm going to re-enter the position if things turn back around, or I want to be alerted to the possibility of re-entering the position. So that's kind of how I do things, but I'm always looking to, is there a plan for re-entry? And in most instances, if I'm cutting something off before a stop, it's always either because the train didn't come in on schedule, so to speak, or my overall trading is not going very well.
Real quick too, I always say you can't kiss all the girls. There's going to be a lot the stocks that take off and blast off, and a lot more stocks are going to go up and make big gains without giving you buy points. But again, that's the upside. The downside is what you got to concern yourself with. You got to put yourself in that position to have that happen on occasion. But the downside is what you have to be concerned with, not the upside.
On that note, I'm going to grab some lunch here.
Go right ahead.
This is a question that also was asked a few times in the markets, a concept that I will admit and acknowledge took me years from tutelage from Mark to understand. And now that I get it, it's so obvious, but I know a lot of people may be struggling with understanding the benefit of selling into strength. And Mark Ritchie, who just stepped out, made a comment back on page 379 during the presentation.
Yeah.
And the question was, what does the benefit of the equity curve smoothing do for you? Because the example here was you were selling into that, gap or move up into the 24-25 area. And Mark Ritchie made a comment, he would be selling into probably that 22. The first gap
on the right slide. First of all, there's no 24-25. What are you talking about?
379.
Okay, I was going to say we're definitely on the right slide here.
Yeah, you're right about that.
Hold on, 379.
Yep.
Yeah. So go ahead.
So Mark Ritchie made the comment that he would be selling into that gap up around 22. And the comment was the person's asking why, and it did continue higher to 25, and why not just let it see if it could go higher and then have it your backstop it at 22 at that point? What would be the difference or the benefit of selling into that strength at 22 instead of waiting for it to come back to 22?
You don't have the benefit of hindsight. You don't know it's going to go up the next day, first of all.
Right.
It's easy to say now that you see what it did. So I don't understand. I don't understand the question of the comment.
Yeah,
it's getting climactic. So we're getting out when the getting's good. You don't know when it's going to break. So you've gotten the 8 out of 9 days up. You got a gap or two. You got the largest uptake. Okay, maybe you didn't have the widest spread at that point, but it was up. It was accelerating. So and I wouldn't even sell all of it necessarily. This is where you start scaling out. As it goes up, you scale out, and then you maybe backstop the rest, or you sell part of it. So you certainly could, do a partial. but you don't have the benefit of hindsight. And it's not about getting perfect, of getting out at that exact high. It's about making more than you risk. You guys got to understand that this getting the highs, getting the lows, getting it perfect, that's not what it's about. It's about the general vicinity of where the stock is now. The risk outweighs the reward. And now the risk of it coming in and giving back all your profit, like this stock came back in, from 25 or so back down to 18 change, is increasing, and you've accomplished your goal. You've accomplished your goal. Look, if you want to play for a bigger move, you can put a backstop and you can hold it. You don't have to sell it. It's all based on your plan and what your goal is. You have to have a goal and a plan. Some people, they want to trade their way to the big return and minimize that drawdown, so they're selling at the strength and taking the short-term moves. There's other people that want to have a more passive style, and they're going for the bigger moves. Well, you're going to have a lot of times where you're going to give back profits, and you're going to have to go through that to get to that. Everything has a price. It all has a price, but you have to keep your eye on the not just the prize, but the process and the goal. What is your goal? Your goal is to make more than you risk, and to do it as many times as you can. It wouldn't matter. Let's just say I bought the stock right here and sold it 2-3 days later. If I can do this X amount, if I can cut off the downside in relation to this upside, right? This little tiny microcosm of all this price action. This is where I operate. This is my whole operation, is in these little short-term moves. Well, if I can reliably get this on average, let's just call it 10%, and I can keep the downside to 5%, and I can do it 40 or 50% of the time, I make a fortune. See, because that's what it's about. It's not about looking back and saying, oh, well, I want to sell at that high or buy at this low. And that's what people get into. Everybody wants to buy Facebook now at the low. They want to bottom fish to Facebook. They look at how high it was. Oh my God, it's down 75%. How much lower can it go? 100%.
Mark, I think we
I know
did.
I'm going on a tangent, and I know I'm going off things here, but I want to make sure I keep you on what's important. But go ahead.
Yeah, I think we did a study that showed for the trailing stop, it was something along the lines of 10 to 25% is what you give back of that profit that would have been taken had you just taken it, into the strength originally. So you may want to do your own study to see, as you learn better how to sell in the strength, how much are you giving back when you do that trailing stop? Because by definition, it has to be lower.
But it goes even more beyond that. There's things that, again, my karate teacher used to tell me when I started thinking I got it down, and he'd say, I taught you everything you know, but not everything I know. So there's more to it. All right. There's even more to it, because when you have a situation like this, all right, and let's just say you're using a moving average, right? All right, let's do this. Okay. So now here's the moving average. All right. Here's the moving average. All right. And now you use a trailing stop. You use the moving average. Well, over here, the distance is from here to here, right? You've got this distance, right? So that's your give back. But when you accelerate, and you have these accelerated moves, well, now look what happens. Look at the distance between the moving average, because the price accelerates way away from your trailing stop. And now, in order to get that sell signal, you've got to give back a giant portion. So what Bob is trying to say is that when you sell into strength, what you save, okay, by the time, if you use a trailing stop, or you let the stock go to a point where it's obvious, it has to break so much that you give back so much, it's not worth it. The other thing too is that when they, like a plane that goes straight up, or a rocket, then it when it stalls, it comes straight down. These stocks, when they get up like this and they get so extended, and you got all these sell rules start kicking in, they break hard and fast. This is when they can come in super, super fast. So these are all the elements that have to be taken in consideration. But you'd be better off if you just trust me and you put this stuff, that you'd be better off than trying to figure it all out. I figured it all out, and O'Neill figured it all out, and guys like Mark Ritchie came in and said, you know what, instead of me trying to rebuild this whole thing, maybe I'll just do what Minervini's doing and then learn it and get some expertise and then start, and then what happened, Mark? After you did it for so long, you realized you didn't have to figure anything else out new, right?
No, the wheel was still working just fine. Put it that way.
The wheel was, the round wheel, was the best wheel. There was no other way to make a circle. So again, and then what'll happen is once you get to the point where you've got the expertise using these techniques, the subtleties that I'm talking about, you will start to experience yourself, and you'll know all these things. Because one thing that you can't do is you can't force experience. No matter how much I give you, I could give this workbook could be 10,000 pages, and we could do this for the next 3 months every day. And you will never get to my level in that amount of time. It's impossible because I have 40 years of experience. Okay.
You hear me? The potato chips. Sorry.
You're on. Your mic is on.
Turn the camera off, not the mic.
Yes, I know. It's like the time we were at the live event in person, and I went to the bathroom and left the mic on, and everybody heard everything. And I came back in, everybody was laughing. We actually did that a couple of times. Bob did it once.
Yeah, I was first.
You were the first one to do it. So you will learn all these things over time, but in the beginning, there's certain things that you're just going to have to use some guidelines and get there and put in the time. That's why if you don't build proximity to your goal, mental proximity, as you're utilizing these techniques and strategies. And if you're not doing well, realize that you are getting closer. You're getting closer to being proficient at this, even though it may not feel it, and you're going backwards, and you're losing money, and things aren't working, and it's 2 years go by, and I can't seem to make this work. It's the guy who says, you know what, 2 years have gone by, I must be getting closer because I've got all this time, I've got this knowledge under my belt, versus the person who says, I just wasted 2 years of my life. That's how everybody always asks me, how did you make it through those 6 years where you didn't make any money? Because after the first year, I said, wow, I got a year under my belt, I must be getting close. Then 2 years went by, and I went, well, I'm a year closer, so it's got to be right around the corner. At 3 years and 4 years, I went, man, it's got to be any day now. The longer it went, the more I felt I was closer, as opposed to saying, oh my God, I just wasted 6 years of my life. This doesn't work. Why am I doing this? Pounding my head against the wall. That's the way a loser thinks. A winner builds proximity to their goal. They stay the course. They make a commitment, and they keep going. And they're tenacious to get to that goal, but building mental proximity. So my point is, and I know I'm going way off here, but because these rules, there's a lot of things that you can't see, that you don't understand, that you may think you understand. It may seem obvious, but you don't until you get in there and you make these trades. You got to make trades. You want to play the piano? I played the drums for 50. I started playing the drums when I was 6 years old. I'm 57 now. I've been playing the drums for 50 years. You know what? You got to play the drums. You got to go in there. I had to go in there and play the drums, and play and make mistakes and learn. And over the years, that experience, you can't force it. You just can't force. You have the best instructor. You have got the best. You could have sheet music in front of you. You can have the best band. Doesn't matter. You can't force the experience. Get in there and make trades with real money, and make the trades. And that's how you'll learn, and you'll get these answers.
I'll just add too, Mark, I think, because one of the things I remember taking away, it's in my first notebook somewhere. And for those of you guys who want it, here's a stack of some of those notebooks right there. But of old workbooks. Mark said most traders overestimate what they can do in 2 years and underestimate what they can do in 10. And I put that in my books. Like, this isn't a 1-2 year, ride. I'm
5-10.
Yeah, and that has definitely been true. I thought I was going to make $1 million the first year or two. It took me longer. But if you told me then, that I'd be where I am now, I would have said, yeah, I think I'll take it. But the idea was you had to have a longer term perspective, in mind, and expertise. I continue to get better at this. People, how long did it take you to figure it out? I usually answer, I'm still figuring it out. I feel like I'm getting better all the time. So viewing it as a process, not that you're going to hit your destination in, a few months after this program or whatever.
Yeah, and I definitely I'm never going to peak. Like I'm never going to be where I'm the best I can be at this. This is like a golf game. You're never going to shoot an 18. You know, you're always striving for a better score and to get better at this. But the difference between me and the average guy is that I make smaller mistakes, and when my expertise is my good stuff is better, you know, and my bad stuff is less, and I'm able to manage it in a way, but it's still imperfect. You know, I am not perfect at all at this. I make all kinds of mistakes, and I'm still learning every day. Everybody is.
Mark,
Everybody.
I don't know if you're able to pull up your charts again, but ADM on the intraday is sending up a real just right now as we
It
speak.
just
right
went.
now.
Oh, it just went into new highs here. That's good. Good. Once again,
But
we're erasing some of my
But look
luck,
on the
you know,
intraday on the 5 minute, you'll see a setup that
yeah, I'm not really set up for that right now, though. But
yeah.
but
If
I
you're
see it.
looking at
I see it
ADM
came
on a
out a little.
5 minute
It's a little.
chart,
I have it on my other on my order entry screen. I can see it's a little mini VCP. It's coming out of right now.
yep. And also even
Classic Bob, always pointing those out.
that's how I do it. So I'm working off of the daily chart, stocks that we have a swing trade on based on a daily chart. And now you're just looking for that incremental opportunity to trade around that core with these types of setups. And, you know, you're on that type of mini VCP on intraday, you're talking about, you know,
There it is.
20 cents of risk.
There it is.
20 cents of risk. You know, you
There's
could
the
get
chart here.
that.
So we're at the high of the day here. Can you see that?
Yeah, yep, we do.
We're at the high of the day. So this is acting really well. And what Bob's talking about is right here. Here's this little mini VCP. See how even on the 5 minute, look here. You have your little cup with candle right here. Here's a VCP breakout. Okay, comes back. Natural reaction, right? Tightens up. Low cheat or cheat, whatever you want to call it. Handle. Look at quick breakout. Now, same thing. Go through VCP breakout. You think it's a coincidence? You think it's a coincidence that the price action forms the same pattern over and over? The volume dries up, and at the same areas, it expands. The advances are strong coming out of those areas. Weekly, monthly, daily charts, intraday charts. You think that's a coincidence? After millions of charts, I've seen this. Millions. I've done hundreds of thousands of trades.
Look up Monster, Mark, also. Monster, same idea. We have a stock on a trade, on a swing trade based on a daily chart.
Came out a little. Here's the little cheat area right here. Come out
this morning.
Natural reaction here. You're even
You're
getting a little failure reset. Came out here. Now it came in, and you get the failure reset. And there you go. There's a little pause pivot. Like if this was a daily, you'd be buying it right here. Now that the question will be asked is, well, can we buy this here on intraday? Sure, but the move might be $1. It might be 50 cents. You know, everything's going to be way compressed now. So you have to realize that.
But I know plenty of folks who come to the programs and trade. Bob being one of them. Bob will Skype me. Hey, did you see the little 5 minute VCP? It's like, no, Bob, I'm not looking at the 5 minute. But they're everywhere. They're everywhere.
And then and this is, keep in mind, guys, the Nasdaq's down a full percentage point today. The market's down, and our stocks that we're looking at are up, completely ignoring the market, and even though the market is getting a little rally here right now in the last 5 minutes or so, but that just shows you
exactly what I said. Remember, I said we might get a later day rally, and then the stocks that broke out will pull in a little bit, but won't stop you out, and then they'll strengthen into the end of the day. It's exactly what's happening. So we'll see how we end the day here. But again, this has to be put into perspective. If we're assuming this is the daily, then this is the weekly. So we have to see what are we in a late stage base? Are we extended? So this could be coming from an extended period, and then we go back to those sell rules. Where is it a breakaway move, or is it an exhaustion move? So it still has to be put into perspective. If you're going to trade on the daily has to be put into perspective with the weekly and the longer term. Just remember this. Here's the general rule, and I should put this. I had this in the workbook before, I think, somewhere. But your current chart is only as good, a shorter term time frame is only as good as where it resides within the longer term time frame. All right, if you're intraday, it's only as good as where it resides within the daily. And the daily is only as good as where it resides in the weekly, and the weekly is only as good as it resides in the monthly, and so forth. Why? Because if we're in a downtrend, well, then sideways action and line of least resistance is going to be on the downside. It's going to be on the downside. If we're in an uptrend, line of least resistance could be on the upside, because in a downtrend, we now have big institutions are selling. There's distribution. See, we're requiring the win to be in the sales. The whole idea of the supply not coming to market and weeding out the shorter term players and the weak hands is because we're making that assessment that there are big players that have an appetite. And that's what creates the supply demand imbalance. On the flip side, when you get that no supply, well, the supply demand imbalance is on the supply side. You're in a downtrend. The big money is selling. So you create the line of least resistance is to the downside. And now you'll be looking to short. So it has to be put into perspective. And that's why I started the whole workshop off with reference points. We have to have reference points and a chronology to this, that you have to understand where you're coming from and have those qualifiers, because this doesn't work if it's not put in the right context and stacked in the right direction with all the probabilities all stacking on top of each other. When you get it all right, though, when you're in the right environment, it is magical. That's all I can tell you. Absolutely magical.
That does lead to a question with the intraday stuff, but a question
Back to the
was,
workbook, or are we going to stay on these charts here? We got
just a general question. Do you trade in the first 30 minutes or 60 minutes? Some people say
I
to
do.
wait.
Yes, I do. I don't wait. First, couple minutes, if something just comes ripping out in the first 10, 15 seconds, I pause usually, and I see if that's a quick, if they're just taking it out on low share. Sometimes they just run it up a couple hundred shares right on the open. I take a little pause, but no, I'm buying the stocks when they break out. I'm letting the chart dictate, not the time in the morning.
Question being asked: any other tools one might need besides Marcus Smith for screening to complement trading your strategy?
Just some a quote system, and real-time charts, and Market Smith I use for just screening, and that's pretty much all you need. I mean, you want to get something for earnings reports like a briefing.com or some of, a product like that for checking news. But you don't, it's like the beautiful thing about trading, it's just like poker. There's a saying, all you need is a chip and a chair. And then guess what? Then it's up to you. It's up to your talent. Just like baseball, all you need is a bat and a glove. And then it's all based on how well the operator, how well you swing that bat and catch the ball and throw the ball. In bowling, you need a bowling ball. That's it. A bowling ball. You show up, it's up to you now. Boxing, 2 guys put on boxing gloves. Best one wins. That's what this is about. You don't need a whole lot. It's down to you. It's down to the skill. It's not, there are no programs. There's no indicators that are going to make you rich. It's you knowing that indicator. And if you're going to use stochastics, great. Then I'll tell you what my father used to say. My father used to say, I don't care what you do. Whatever you do, though, just be the best at it. Do the best you can. Whatever it's going to be. But go all in. Don't pussyfoot around. Go all in on it and be your best at it. So that's it. I picked this particular style, stayed with it for 40 years, and became an expert in something. That's what I advise you to do. Pick something. It doesn't have to be this. It could be something else, but pick something, because you're not going to be good at everything. And there are no magic formulas or indicators. It's going to come down to real work. If that was the case, everybody would be worth tens and hundreds of millions of dollars. Everybody would be like Mark Minervini and be able to make all this money from trading stocks. But that's not the case. Very few people can, because it's a game of skill where a lot of money goes from a lot of people to a small group that are skillful, just like in baseball. How many pitchers get tens of millions of dollars of contracts and quarterbacks and it's the same principle anywhere. There's a small handful of elite performers that get it and commit to it and become great. Got to give yourself the time to become great. You got
Question
the
being
tools.
asked.
You got the tools. Now, do you have the wherewithal? That's the question. Do you have the willingness? Do you have the discipline? Do you have the commitment? Do you have the wherewithal? Do you have the ability or the willingness to commit and to stay the course? You have the tools. I promise you, I gave you everything you need.
Question being asked to Mark Ritchie if he had any special strategies on incorporating all the content you learned from the Master Trader program yourself. And just making a comment, he assumes it took some time for all these strategies to show up in your trading results.
Sorry, here, chewing a little bit.
Not really, seeing as you won the triple digit challenge in the
In
first
6
6
months.
months. Didn't
That's
take
right.
very long for Mark Ritchie.
Let me put in a few caveats. Well, the first thing I did, first of all, I think that you phrased it strategies, Bob, or something like that. So I went home and just started screening right away. I actually never screened a stock before coming to the first Master Trader program. I didn't know anything about it. In fact, the service, the MPA and all that this was all kind of coming out new at the same time, you know. So talk about those of you guys who feel like you're drinking from a fire hose. I felt the same way. I think I even got the screens I'm using now. I think I got from somebody else who was attending, because we didn't even have a section, Mark, if you remember, where we went over the screening process. It was just sort of some general guidelines, you know, stay away from stage 3s and 4s.
Right.
You guys are getting more now than
I think the workbook was like 180 pages. Now it's 530.
Yeah.
There's a lot more meat on the bone for sure.
Yeah.
We definitely did not share any of Mark's screens in his first few years.
No. And long story short, I just started screening and looking for the pivots, and I had already been swing trading, and this style, I would say, fits my personality. There's no question about that. There were some things that were definitely intuitively easier for me, as I've tried to teach this to other folks on the platform, whatever, realizing you get a lot of the same questions that people just have a harder time grappling with some of these ideas. But for me, I would say the biggest thing was just refining your eye. I look back at some of my old stuff. I was like, that was sloppy. This was sloppy. Just getting more and more refined in how you see things, catching more little nuances in the charts. And then, look, I went to every weekly Q&A session for, I don't know, 5-10 years, asking questions just like everybody else. After a while, I didn't ask many questions because, then I'm just trying to provoke Mark to get on tangents, because you could still pick up lots of good gold nuggets in terms of what does it take to be successful? How do you think about this situation? How do you think about that situation? Mine has always been too, if I'm in the right frame of mind, I'm going to make good decisions. And so if I'm thinking about things correctly, I'm a big believer in, from right thought comes right behavior. And that's really what these last 2 weekends of me are really all about, teaching you how to think about these things and dispelling some of this nonsense you hear out there in regards to, you want to trade volatility or widen stops and, averaging down, all that kind of stuff. And then the other thing I would just add, though, one thing, as the account grew, trading size definitely took some learning, because initially, I would just buy it all in one hop, where you could turn your whole position over really quickly. That definitely took some getting used to and learning how to do that properly as well.
Yeah. So with regard to the charting, it takes time, and it's all right here in front of you. And again, I would caution you to, as Mark is saying, to narrow it down and try to insulate yourself from the noise. That's our goal here, is to show you what you need to focus on and how you need to think, and then it's up to you, to spend the time putting it into practice and getting the experience.
I will add one other thing too that I've always encouraged people is to, I've never been a journaler, mainly because I have a really strong, I just have a memory, where I can remember certain things. But I think most folks that I've seen that have been successful at any type of trading, every now and again, they sort of have these aha moments. And the golden nuggets really, I think, are designed to sort of pull those out of the material, but you'll have them in your own trading. And so there've been a few where, everything just lined up and you saw things, work out right. And I feel like you just kind of have to go through some of those to say, you know what, when I see this again, and the reason we tell the COVID story, I've seen lots of waves of setups, never one where I thought the world was going to come down to an end.
Yeah.
And, I just know if we ever get into a period again where people are that skeptical, scared, pessimistic, and the stocks are setting up, if I could be even more aggressive, I'm going to be even more aggressive. So the longer you do this, it will just increase your confidence. And every now and again, you have one of these moments where you go, now I get it. Now I see it. So I just encourage you to write those down as they come.
And the only reason why I probably was able to tell Mark Ritchie in the first couple months of the rally off the COVID bear market that we're going to buy the stocks is because I had seen the potential world coming to an end. That was completely different. I have to say that was more scary than probably anything that I've ever seen. Although 9/11 was pretty scary when it was happening, and the '87 crash. But I wasn't really involved as heavily as I am or was later. But I went through the '87 crash. I went through the bear market in 1990. I went through the 2000 bear market for years. That was 3 years long, and the World Trade Center coming down, and the 2008-9, financial subprime debacle and financial system collapse. I had gone through a bunch of those, so I started to learn that the market discounts this stuff, and that I gotta let the head, not the tail, lead me here. Otherwise, I probably wouldn't have bought any stocks, and I would let my emotions over. So, I had to trust my experience. And before you can trust your experience, I guess you got to trust somebody else to a certain degree. And that sort of bridges you to get your own experience. But you're probably sometimes going to be where, even though I told you all these rules and Mark Ritchie told you all these rules, and you know everything, you might not do it just because you haven't seen it enough times and you're scared to death. And then you'll see over time, you'll see what works, what doesn't. And then if you stick with it long enough, the truth will rise to the top. Cream rises to the top.
Something else I meant to
anything
add.
on the workbook? Because I know we keep
Yeah,
getting off the
going
workbook.
A lot of questions
Yeah, I'm sure.
put in there, very journalistic.
Problem is, when we're doing this, we get hundreds and hundreds, sometimes over 1,000 questions, and Bob sort of tries to bounce around and get questions not answer the same thing over and over. And there's a lot of questions to field. We certainly can't answer them all, but try to get all the relevant topics.
One of the things, though, when you were stepped away for a moment, Mark, that Mark Ritchie was answering the question of sort of how to manage a trade, essentially. And one point I wanted to just emphasize was, if you listen, Mark and Mark both have a plan of not only getting into the trade, but they also are visualizing all the scenarios that could happen once you're in the trade. So what if the stock continues going up? What if the stock starts pulling back? They already have an idea of what they're going to do in certain circumstances, no differently than playing sports. If a second baseman knows the ball is going to be hit to him, there's a runner on first, he knows he's going to go to second, or whatever might be the case. They're already pre-thinking through, visualizing exactly the scenarios that can happen. So nothing surprises them. And that's something I think
but
is
again,
helpful.
Yeah, I think you still got to be careful what you say, Bob, because that almost infers that we've got targets, and I can be very surprised. But I have a response. What Bob is saying, that I have contingency plans and a response for everything. For instance, if I'm surprised with a giant, this stock gaps up huge on me, or takes off right now on news, I know if it's up real big and it's extended, I'm going to probably dump some right into strength. I mean, I have a pretty good idea of what I'm going to do. It may not be an exact plan, and know if this stock goes to 110, I'm out. I don't have those hard fixed rules like that, except on the downside, on the risk. But yeah, as Bob is saying, we in our mind's eye, we're pretty prepared for just about any eventuality, and that's in the contingency planning. Like I pointed out, we ended the day 4 with some closing remarks, and I talked about contingency planning. First of all, your first plan is you got to have a criteria to buy and to minimize your loss. From there, selling at a profit, selling at a loss, selling at a profit into strength, and selling at a profit into weakness, and then a disaster plan based on your system and whether it goes down, you get locked out of your brokerage firm, then it goes to that plan. So all those things, then you, like I said, then you get a playbook, a full playbook, that you can handle just about any situation. Like, you're in a 757, flying, the pilot, they have protocols. If an engine goes out, there's protocols. And if they don't know, they radio to the tower, they tell them what to do. There's protocols based on experience and building this playbook. And if something happens that they don't have a counter move for, they add it to the playbook. So you got to build your playbook, and that takes time.
Question being asked, if Mark, Teresa's asking, she knows that you don't like cyclicals, oil and gas and energy, but if the market in 3 to 6 months turns out that is what is moving the most, like it has been for the last 3 to 6 months, what from history would that tell you? Not sure.
Well, tell me that we're in a period where, those stocks are in favor for whatever reason. And if, and again, if we see a whole bunch of setups here, they start meeting the criteria, I'm going to probably take a few, not going to completely ignore them. I'm not going to fight with the market because I don't know. History says that these cycles move in 8-year cycles. I pointed this out in a note that I put out to our members. We're in a couple years into a potential 8-year cycle. So we still could have a long way to go on oil names and energy names, things like that. Deep cyclicals like papers and steels and so forth, I mean, they'll probably have a shorter lifespan and move with the economy. But I'm not going to dig in and not bend a little bit. And so maybe I take smaller positions and have smaller exposure. And I don't, for this next cycle, I don't make as big of a return as I normally make. That's okay. It's all right. It'll be that, as long as I protect myself on the downside and I'm making money and doing well in the market, and I'll have periods where I do really well, periods where I do only okay, and periods where I don't do so good. But over the long term, that's how I've amassed my performance. And Mark too. Mark had a few drawdowns early on, some pretty decent drawdowns off the high. He had to learn, and if you look at his performance as he's gone on in the years, the drawdowns have gotten less and less. But he's managed to have an amazing track record over a 13-year period.
Question, Vanna is asking, sort of kind of a paraphrase it, but basically she's asking why you're buying Monster with EPS, earnings per share, declining. Would this be an example of differential disclosure?
Let's bring it up first of all. So let's see here. I'm going to just widen this out here. So a few things. Well, first of all, yes, it is. I would say that's a good to point out differential disclosure. Okay, so the earnings are negative in the last 3 quarters, but the stock is hitting, I believe, near an all-time high. Right? That's just, again, this damn thing drives me nuts. Hold on, I got to move this Zoom bar. Okay, let's bring up a monthly. So we're up around all-time highs here. Look at the market. There's the market, the stock, and I'm going to go to a weekly now. So the relative strength line during this correction here, stock is acting pretty good here. And then I look here, I see all this, these earnings where they peaked over here, and they started slowing down. And you got between 2020 and 2022, you went up a little bit, and then you came back to that 230. You're basically in that 230 range. And now you're looking like this next year, you got a breakout year where that'll actually be the biggest earnings, annual earnings. And these estimates are probably conservative. That number if they execute properly, that number will probably be bigger. We talked about that, how the estimates are conservative. This is probably a conservative number. The stock is telling you that it's acting really well. So I think we're trading on future earnings here, looking at the estimates. And the bottom line is, yeah, the stock is acting really good in the bear market. The problem is we don't really have much of an uptrend. So if we get it right, maybe we got it a bit early here. I mean, okay, so you said the negative number. I want to show you one thing that sticks out like a sore thumb, right? So you're looking at the number. Remember I said the number don't trust the number, trust the response to the number. Look at here. See right there? That's when they reported earnings. Look at the response to the earnings. The stock has got its biggest up move since it's turned into an uptrend here on that -5%. Well, that -5% obviously was a pretty damn good number. Had to be. There's no way the stock is going to go up on this giant volume. Let's even look at the weekly. Look at the weekly here. Big weekly move up. And look at this. 1, 2, you got 2 tight bars, 3 pretty tight bars. No variance. Like it's held that move. It's not like it popped up on retail money and then came selling off. It's holding up. And now it's breaking out here. So the stock is telling you that this future number is what it's trading on. And now we've got to see if these numbers start to come in. Future earnings reports are going to be really important because this is obviously trading on the future. Stocks are always trading on the future. All right. But sometimes the earnings are on the table and sometimes the earnings are on the table. You've got the earnings and it would be just the opposite. As I pointed out, we saw Crocs come up with 155% and the stock was down 15% that day. So again, you're going to look at the number and go, why are you selling that stock? The earnings came out 150. Let's reverse what you said. Why are you selling the stock? The earnings came out 155% because the stock's down 15%. Same thing in reverse here. So that's the reason why. Now, I could be wrong. This might not work. But again, if I put myself in this position 100 times, 1,000 times, and I manage the downside in relation, I'm going to come out a winner. These trades are going to deliver more on the upside than I'm allowing on the downside. And that's all that matters. Whatever earnings they come out with, it's the response. It's how the stock is acting. Now, I'd love to get it all. I'd love to have big earnings and have the big response. Those are the ones that usually give you your bigger moves and the sustainable moves when you have it all on the table. And this might happen at a higher level. This stock might be just starting to get into that strong stage 2 uptrend. And 6 months from now, 2 quarters, 3 quarters from now, we've got big earnings in the current quarter and the stock is coming out of another base. It's coming out of a second stage base now. And I'm buying it there. And that's actually a better trade at a higher level. You see, not the lowest price, the right price.
Question is being asked because of the bear market circumstances with the downtrending market. Would you look at the 3-month relative strength rating on MarketSmith versus a 12-month, because that will be showing you more of the stocks that have been performing well in the last few months?
No, I wouldn't. But if you want to see what's performed well, like during a correction, versus that time period, like sometimes in a shorter term pullback, market's down 6 or 8 weeks, or in a bull market, and the market's pulled back for 6 or 8 weeks, I'll run a 6-week RS. I'll run an 8-week RS to match the time frame. You could do that. You could just say what stocks from that point do a rate of change. So what's the rate of change? And then sort it by the biggest to the smallest from a particular date. So let's just say you're going to measure it from where the market topped. And let's say that's 3 months. Well, if you ran the 3-month, then you would see the stocks are the strongest during that period. Yeah, you can do that. I think that's good thinking. That's a very good way to think about it. But I have found that I don't need to do that. The relative strength rating is fine. And also, just so you know, the relative strength ranking in IBD, the 3 months is 40% of the ranking. So it is weighted already towards the most recent 3 months. Can't hear you.
Thank you. There was a question earlier this morning, if you could pull up end phase, which was asking, Jason was asking, with it very close to our stop, would you just sell the position? And you can see now exactly why we don't do that.
It's coming back now. Yeah, I'll bring up a current chart of it here. ENPH. So it did come down, but see, it's getting a pretty good so far. If it closes here, this is great action. This is exactly what you want to see. See, again, while those who get stopped out and those who are undisciplined and those who are in there creating the noise, we being one of them at times, while they're in there getting whipped around, they are forming the basis of your success as they're getting that process of weeding out the towel, getting squeezed and the water coming out. This is just another iteration here. And if we can tighten from here, this stock is proving that it's going through a very nice natural changing of hands of weak hands into strong hands. And this stock could be set up in short order here, but you got to be real careful about, if you're going to get in there and trade, if you start try to trade every little blip, you're going to be in and out and you're going to be losing money because you're going to just get whipped to death. There has to be, you've got to have a cutoff. Now, yes, you can trade really short term if you want, but then you've got to truncate everything. You've got to, your gains got to be, you've got to adjust for all that. And you're going to have a lower success rate. You're going to get stopped out a lot more times. So it's all maintaining and it's all adjusting and maintaining that risk reward relationship. So if you want to sell it here, you could sell it. But when it gets really close to the stop, that's the time where I'm not going to sell it, because if I put a 6% stop and it's down 5, why would I sell? I got 1 more percent to know if I'm right or wrong. I might have told the story before, but good friend of mine who was one of my very first assistants back in the 1990s, we bought Stryker. We bought it on the same day. He used to sit right across from me. Our desks were right next to each other. I bought Stryker. He bought it. Stock took off. And anyway, stock came back and came right down within 1/8 of a point. Back then we traded in eighths. Came within 1/8 of our stop. It was like an 8% stop. He said, I'm selling the stock. I said, why would you sell it? It hasn't hit our stop. He goes, it's definitely going to hit the stop. It's 1/8 away. It's 1 tick away. I said, well, you could sell the stock. I'm going to give it the 1/8. Why would I sell it now if only 1/8 more? I'm not going to lose a whole lot more. Long story short, to this day, he still talks about it. He's brought this up to me many times. The stock turned around, never hit that 1/8, and went up and tripled from there. And I made a double on it. So, again, now the caveat to that is it's at the end of the day, right? And the stock is going to close right near your stop. Now you're taking the overnight risk because you're so close to your stop that the next day, if it gaps down, let's say it gaps down 3% the next day, now you're going to get 2% of slippage. So that would be a time where you might, if it gets close and you don't want to take that overnight risk, you've got to understand that now I just increased my overnight risk because now it's closer to my stop and a gap will give me more slippage. So see, there is a little caveat to that. So your thinking is not completely off. It just has to be put into perspective.
I still laugh when I hear that story. I've heard that story for decades. On page 488, if you want to go back to the book.
Those of you who heard the story about the throwing the money out the window, and the friend of mine that was in the car and refused to throw the money out the window with me is the same guy, by the way.
Yeah, I was going to say.
It's the same guy. Yep. And I told that story again. I'm not going to tell the story. Maybe at some point, if you guys want to know, there's a link. Someone did a story on it. It was interesting the way they did a story on it. My friend, he came to my house to visit me one day, and this is literally 30 plus years later. And I opened the door. I didn't see him in a lot of years. I opened the door, and he went, his very first words, he said, I should have threw the money out the window. And then he gave me a hug. I'll leave you guys hanging who don't know that story.
Before you go back to the workbook, actually, PWR, Mark.
PWR, I saw that one on the
Yeah.
weekend. It was setting up in this couple of handle type pattern. It looks pretty good. it looks pretty good. I'm trying to remember why I passed on it as far as putting it up. Yeah, it looks pretty good. You know, it's the building heavy construction. I know Floor is doing. Is that the same group, Floor? Because Floor was broke out, and that was one I put. Yeah, Floor is number one. There it is. So let's take a look. Whoops, sorry about that. Go back here. Floor. Yeah, that one came out. And we actually put this on focus list a couple weeks back, right over here. And that's working pretty good. So yeah, I think it looks pretty good. The PWR looks pretty good. Again, here you have your top stocks. It's the second relative strength stock in the group. So that looks fine. I think I'd want to see maybe again a good market. You know, I'd be all over a chart like this. I would already be buying it over here, right out of here. I've been buying it coming right out here, and then if it comes out from here, I'd be adding to it. That's sort of how I would play this. You even got a little low cheat right here, but with a lot of overhead. So this is a bit low, a little bit below the 50-day. But I would definitely here as it shakes out and then breaks out right here, and you come out in the volume, you come out in the earnings right here. That's a perfect spot to start entering it. And then you get the natural reaction. It holds up. We get into new high ground, add to it. So I think you could buy this if it comes out. It got through the earnings, had a pretty decent response on earnings. And now that it's pulled back, I'd like to see it tighten up a little bit more. Optimally, this is what I'd like to see happen. I would like to see this back off a little bit and tighten up just a little, maybe even drift back a little bit, and then come out from there, maybe just a little bit more, and that would be really, really setting up perfectly. You see, right now, trades aren't working well, and we're in a bear market. So I'm going to raise the bar for the requirements, because in a good market, you get bailed out. You make mistakes, the market bails you out, right? You've got the wind in your sails. In a bad market, you do things near perfect and you get penalized. So I want to, at the risk of missing stocks moving, I'm going to make sure that they're perfect. I want really, and if they're not perfect, I'm going to position size accordingly. And I'm going to offset the risk in one way or another. But generally speaking, I want the better setups, the better plays, the highest relative strength, the real crisp entry points, the lowest risk entry points. And also, I may not play everything. You know, I just may pass on a bunch of names just simply because I don't want to get too involved in the market right now and start shotgunning, because again, it's not working. So I don't want to get myself enamored with too many names.
PARR, another name, have not quite similar, very close to 100% move, but not quite meeting that criteria.
I'm playing this, playing ADM like remember I said I was going to play this like it's the daily. I just cut half off here. So I cut half off here and sort of free rolling now, a little bit in the bank. It's rolling over here now. But again, if you're swing trading, I want to make sure I reiterate this. You know, you wouldn't want to be selling this quickly. You know, on the downside, if it pulls back here, you could let this squat, give it another, you know, a couple days, a couple weeks to see if it could reverse a recovery. Stick to your original stop in the beginning of the trade. Go ahead. I'm sorry. What did you say about the question?
PARR, another one that is not quite 100% move.
PARR. That's the yeah. So let's see. Just looking at the weekly here. And I'm going to pull it up here. Oh no, Market Smith. Whoops. Yeah. So as a power play, I guess.
Yeah, not quite 100%.
Well, it falls quite short. I mean, it's not. Let's see, what percent? Yeah, it's 73%. That's not even close. You know, if it was 98%, but that's not enough. So I would pass on that.
Question being asked: when you want to see the volume dry up in a pivot, does it matter if it's an up or down day? Does that have any influence on you?
What part of the pivot? An up down day?
Where the volume is drying up, like just before it breaks out.
No, it doesn't matter. But unchanged and having low variation, and closes that are close to the previous day close is even more constructive. The least amount of variation is better. So you're just looking for, because volatility and volume means supply. That's the bottom line. Okay. When you see volatility, you see volume, supply. All right. That's what you're seeing there. Now if stock breaks out and it takes right off and there's no downside, that's alpha, that's demand. Okay. So what you're looking for is those tight variations. And that is also on the close, looking at it from the previous day is something that is constructive, especially on the weeklies. This is what O'Neill calls 3 weeks, 4 weeks tight. There's a reason behind that, because those are the footprints of accumulation, of strong money sucking up the strong hands sucking up the weak hands. So, but no, within the pivot, real tight in the pivot, would it matter here if this day right here was down? This day here, you see this day, it's on the low here. I'm still going to buy it coming out here when it takes out that high. That's not going to change it. If it was up or down, wouldn't really change it.
So curious to see what your chart looks like on TRQ. It looks like a stock that a new issue, but I have some historical data on it.
No, yeah, it's a mining stock. I see how it's showing pretty tight action here. TRQ.
That's
Yeah.
weird. Mine looks completely different from that on
Hmm.
TradeStation.
Yeah, it's trying to tighten up over here. Volume's coming down. Doesn't look too bad, but it is a mining stock. Be a little careful with it.
Okay. A lot of the questions were more for the live trading day here, not as many.
Okay, that's fine.
But let me just keep trying to
We
plow
can
through these.
stick to questions about today.
There was a question asking if you could just share a quick explanation again of the difference between a cheat and a low cheat.
Okay. Let's go. Where would that be? The page, Bob?
Yeah, the three.
The three.
One.
No. To the three.
No, it's no, it's one.
I got it.
You do.
So
Yep.
the low cheat is going to be in the bottom 1/3 of the base, and the cheat is going to be in the middle 1/3, and the handle will be in the upper 1/3. So just think about it, as the low cheat is, it turns up and it has that pause, but you've got some supply to the left. When you get to the cheat, you have less supply, and you get to the handle, you have the least amount of supply or no supply if it moves into new high ground. So the difference is it's just lower in the base, and you have more supply. That's why as we go down in the base, it becomes more of an expert buy, because you have to analyze the left. You got to look left for traffic and analyze the traffic a little bit more accurately, because you've got more potential selling and more supply. So that's why the lower you go, you have more opportunity, of course, because there's obviously you're buying it lower, but you also have more supply to work through. So that's where you've got to make that determination of how deep it is, how far back it is, and that will sort of guide you whether how strong you should be playing the low cheat versus the handle or the cheat.
On page 314.
314, yeah. Yep.
Why are you buying where you're buying? There was reduced volume leading up to that, and also much easier. What is telling you to buy at that exact moment is the question.
I don't know what that means. There was reduced volume, much easier. Where?
I guess.
Where was I supposed to buy? I mean, I guess I could have bought this, maybe started buying this right here, but it hadn't taken out this previous high. And I don't even remember, when I saw this stock. David Ryan brought me this stock. Sometimes I don't see the stock until it's set up over here. I can't remember, but this cleared everything out right here. You got where everything got cleared out. And I think I actually bought it on the next day to make sure it was following through. Because a lot of times they'll come out and then they'll come back in, like we just saw, of course, today. And end phase just happened on Friday. So I got a little follow through. So I bought it on the follow through. I bought it on that second day. That I do recall. But whether I bought it the day before or over here, either way, the outcome would have been the same, because the stock would have never hit my stop. Based on this little tight area, I definitely not selling until this comes off a bit here and at least takes out these lows here in this pivot. So you wouldn't have been knocked out either way. You have the same exact outcome.
Page 211.
Yep.
Question being, why not buy it at the box? Because you end up buying it at the same price. It just takes longer.
Okay. So first of all, you're looking in hindsight. So we don't know this is the benefit of hindsight. That's number one. Number two, this is completely this is running right up the right side here and it's completely unsustainable. If you go back and you look at all the charts that you have in my workbook, if you go back, you look at O'Neill's, study the biggest winners where they came out of these bases, you will see very, very, very few that come out of a base that looks like this, because this is unsustainable. And this defies everything I just told you over the last 4 days, defies all of it. There's no time for it to go through the iterations and weed through the supply. So, and we have this big move here. So you obviously have quick profits for some people and you're running into supply. So the other thing too is, again, we're not looking for the lowest price. We're looking for the right price. So you're right. We are buying at the same price. The difference is also, well, I just saved 2 months worth of time or a month and a half worth of time. Time is money. Time is valuable. I mean, if you're buying stock here and getting the same exact result as I am here, I'm going to outperform you, because all this time I could be using that money somewhere else, but with stocks that are moving. So, I mean, I could also use it and lose it. But the point is that it's opportunity cost. I'm tying my money up. You're tying your money up a month and a half, 2 months longer than me. I want to get to the result as quickly as possible.
You're being too generous too, Mark, in my mind. So a little role reversal here, because if you buy those red boxes,
you can drop the velvet hammer.
Well, if you buy those red boxes 1,000 times, you're a money loser.
Absolutely.
In my opinion. I mean, and
if you're using stops, if you're using tight stops,
if you're not losing stops, you're definitely a money loser.
Right, exactly.
Either way,
losing stops, you're definitely going to be a loser anyway. So regardless of what you do,
well, to the point we've made a few times, you want to think about this. You're not going to make one trade. This is a perfect example, though. The price, in terms of the fact that it's at the same price, is purely coincidental. The reality, though, is that if you buy those correct buy points 100 times versus the red box, the return distribution will be massively different between the two.
Yeah. This is where where a pair of eights morphs into a pair of kings.
Excuse me. Here's a good question that we haven't addressed at all. If having these setups and having the benefit of using options, which provides a guaranteed stop loss, being the purchase, the amount of your premium that you're purchasing the option, but you still have the ability to profit from breaking out of a VCP with low volatility. Your thoughts on that?
So you're saying using this strategy, but just using options.
Mm-hmm.
Yeah. So you could. There's a gentleman that was a friend of mine, I've known for 30 or 40 years, does precisely that. He's in Canada. It's been very successful. You certainly could. The problem with that is, or the challenge is, a few things. One, a lot of stocks don't have options. So that's number one. So you do this analysis and you find all these stocks that are setting up, especially if they're smaller mid cap. In the mega cap era, it works a lot better. When the smaller and mid caps are working, a lot of stocks don't have options, so you don't have that opportunity, and those options are sporadic, and there's not many strike prices and so forth. That's number one. Number two, when you're buying or directionally trading, which if you don't directionally trade, you're taking the risk of being at a loss right away. I want to always be trading in the direction of the trade. When you do that, you're kind of, the options defeat your goal, because the premium and the spreads, everything widens with volatility, adjust. So there's premium too. So you can get it right. You can be right on the timing, but there's a lot of premium in the option. And now it takes, the stock is not going to move in lockstep unless you're buying deep in the money. And even then, sometimes, you're not completely apples to apples. You're not moving in lockstep. Sort of like an ETF. This is probably not the best example, but a triple ETF, over time doesn't move in lockstep with the market. It decouples. Well, same thing with options. There's wider spreads, there's bigger risk. And then of course the real reason is because their timing has to be absolutely impeccable. So if you go into a stock and now you happen to get it wrong, but it takes a couple weeks, while it keeps building that VCP, but it doesn't hit your stop, well, your option's worth less. You're losing money when you wouldn't be losing money in the stock. So there's a number of challenges. It doesn't mean it can't work. If you need leverage, if you want to use leverage, then that's a way to get leverage. If you didn't, you had a small amount of money and you wanted to use leverage, you could do that, but it will be challenging. It's not easy. It's making this much more difficult, and that's the bottom line.
Somebody was noting on your watch list, Mark.
Real quick, sorry, I just wanted to note that you see this here. This is very similar, especially if you look at it right about here to this example here. See, I'm not doing anything different. This, if you go back and you look at what I was doing back in the 1980s, 90s, or you go back and look at Coca-Cola in 1932 or whatever, it's doing exactly what Monster Beverage looked like. They're coming out of these same bases, but you can see, take a look at this here. You're making a turn here. You've got this cheat area. Now, the only difference is over here, it didn't come out and follow through. So maybe it's going to take a little more time. Hopefully this will end up looking like this and will break out and will work. But you could see the setup to it, very, very, very similar setup in the footprint here, the VCP footprint.
Somebody made a comment that you had the letter R next to your stock on deck AMPX. They were just wondering what that was for.
On deck, which one?
AMPX. They said
R.
they see an R on the ticker in the on deck list.
Oh, okay, hold on. I'll move that over. Here's my on deck list. Where? I see it.
AMPX.
Right here. You mean that little thing right there?
I guess so.
That means there's an alert. It's not an R, it's an A.
Oh.
It means there's an alert set. Right there. There's a, whoops, sorry. Right here. That just means it's an alert. See, there's an alert right here. This is the one that I'm watching that's tightening up here. Getting nice and tight here. You got this little cheat area forming. So that just means there's an alert.
Gotcha. ANET.
ANET, yep.
Which actually on a 5-minute is showing a nice low cheat.
Yeah, wedging up a little bit though. It's not the greatest, but yeah. This is wedging up a little bit here. It looks okay. I mean, I like to look at it and see what it looks like over here. 90 RS. Yeah, this is kind of wedging up here. I like it. You had a good the earnings. Was that after? Yeah, it actually gapped up before earnings. It's acted well after earnings. It looks okay. Let me see the weekly. Again, a little bit laggardish, not really a strong uptrend. You can see, you flattened out. You started rolling over here, started looking a little toppy, and it's holding up during the bear market, but not really looking strong like a leader. You know, you take a look at something like, and again, it might outperform First Solar, but when you take a look at something like First Solar, you know, this is looking a lot stronger. See, the uptrend is more intact here. You're really outperforming the market, just real strong relative strength line. I want to be in the more powerful situation if all things being equal.
Question about CLR. And guys, when you're looking at a stock that is like a flat as a piece of paper,
Yeah,
then
that's a
it's
takeover. That's
almost always going to be a takeover scenario.
right. So that we're not going to bother with that.
STLD.
STLD, which is of course the steel stock.
Was that too extended? Was the question this morning.
No, I wouldn't say. This is a pretty good sized base. You know, this is a deep cyclical, and I've been asking myself, do I want to buy these deep cyclicals and these steels? You know, ATI is another one. Take a look at ATI, where it's, you know, trying to form a base here. Of course, not as looking as strong as STLD, but yeah, I mean, again, it's a matter of if I want to, you know, if I want to start really shotgunning here and buying everything that's moving out. It looks fine. I mean, you could buy it here. You certainly could buy it here. I mean, it's coming out of a really well-formed big base. You moved up on earnings quite nicely. I am being a little careful with the cyclicals, you know, here, I have to say.
There were two questions on
Big deceleration earnings too. Look, about 500%, 187, 98, 10. They're decelerating in the earnings here. You know, 4 PE. When you start seeing these numbers are so dramatic, you know, way, way, way below. And I've got this big deceleration. Now I got negative estimates for it. I mean, this is just all over the place. This just reeks of cyclical, deep cyclical. You know, everything's inverse. You can see how you got the estimates next year are down. PE's a 4. Earnings are decelerating. The stock's breaking out. So you could say, well, you know, trust the stock. Yeah, you could, but a lot of these cyclical moves, when they get to this point and they break out, they don't have the legs. So I am being more careful with the cyclical names at this point. I'm being careful with everything right now.
look at that half of earnings, losing 50% year to next year. So curious, I've had a couple questions on Gilead and BIIB, and I'm not sure, guys, if you came this weekend and paid attention all weekend, how you're thinking these are entry points for.
Well, Gilead is, you know, come up here, and it's certainly not enough to be a power play. It's just starting to turn up on the 200-day. BIIB is a little bit better. You know, you're turned up a bit here. You can see here they just got a new CEO. That's good. The stock actually gapped on that. We got through earnings. But again, an early turn here, not enough to be a power play. So, I mean, I would say you could have bought this maybe back here, coming out here, you know, when it first formed this little BCP, or right here off that pullback buy as it started turning off the low near the danger point. And that's where, you know, I entertained entering it there. I was thinking about entering it right here, but I just decided not to. But they did get some good news over here on this gap.
Question about Mark Ritchie, but just talking about when to be adding to an existing position in conjunction with your progressive exposure. Are you doing that? Really, paraphrase the question. Are you doing that within stocks that you already own, and when would you do it, or how soon before the stock kind of moves away from you too much?
Well, you know, any subsequent buy point. This is a good chart here to the left. This Intercept
Yeah.
Pharma, because this is exactly how
That's why I brought it up for you.
Oh, good. Those 2 buy points stand on their own. And actually, this is an example where I bought some and then pyramided the position up. I think I might have even sold a piece of the first one and then added more on the second buy point. I can't remember exactly, but that's something I'll do from time to time too. But think of it this way: every buy has to stand by itself. So if you didn't buy the first buy point for whatever reason, and you're buying it subsequent, does this meet the criteria all by itself? And then ideally, that's exactly how I want to handle things. You know, if the name I already own sets up, perfect. Now I'm just getting more concentrated, but it's both. It's not either or.
Yeah. Let's take a little break and give people a little time to just rest and recharge a bit here, myself included. Let's take a little break. The market seems pretty quiet here. There's nothing. It doesn't look like there's really much that I'm going to do at this point, trading wise, except the trades that I already have here. ALNY, of course, is still just drifting down. You can just again think of this as a daily. Look at how many days down here and all these lower lows. See that those violations gave you the tip off. It hit those violations and the train did not come in on schedule. And that gave you the tip off. And since then, it's just been down, 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 down. And even though, and now look at the daily. Let's zoom up on this. Now we've got a full blown outside day. So now the volatility has widened here, and that's the opposite of what we want to see. Now, does that mean it's curtains? No, because it's still on this right side, and it still could tighten up here and go inside for a couple of days. And like I said, it would be perfect. So, but this could happen. This is what just happened. How I bought some here, and got knocked out. This happens all the time, and now I'm not going to take this off my list because it's still within the VCP building up that right side, but I'm going to look now for it to tighten up and reassert itself. And I want to see it improve. I want to see this tightness and this price action with the volume get even better. And then I'll be buying it again as it takes out that high because it's still holding up nicely in that right side there. So out of that, ADM still in, took half off as it started to roll over right here. And now, I've got the option if I want to break even or finance my stop a little bit. Not really much. Yeah, the other ones. Now, DGII reversed everything. This is just par for the course. This is what's happening over and over and over and over. This theme just is been in force and just doesn't seem to be abating anytime soon. So again, this is why I'm being cautious and careful and not loading the boat on these breakouts, waiting until they start to work, and it's just not working. CVI, let's see, what's the other one I was looking at? Took out the low. See, that needs more time. So we're in a holding pattern here. We're just in a holding pattern at this point. Monster's up a little bit. We got to see if this is going to hold. This might be another one that ends up squatting and reversing everything. So that's the theme right now. So why don't we take a little break? Maybe we'll take a half hour. What time is it? At least 15 minutes. Why don't we take a half hour? We'll go to 2:45. Get some lunch. I only had 2 eggs for the whole day. I'm gonna grab a quick lunch here, and we'll come back at 2:45. How's that? All right. Let's see. Let me go back here. All righty. You all set, Bob? Can't hear you.
Looks good.
Okay. All right.
It is.
Be
It's
back
kind
in-
of
All right. We'll be back in a little bit.
Recording stopped.